Good afternoon, everyone. I feel extremely fortunate to be here today with all of you, counting on the collaboration of many different entities that we look up to. And this year is the first year where we're coming to Zurich. We're extremely committed with the Swiss market, with the global markets. We've been very happy to see so many faces and with the kindness of everyone we've met so far. And today we want to start by highlighting our admiration for business owners who, with very bravely, are able to convert an idea into a business that offers products and services that people need, therefore adding value to society. If you only take one message from me today, I want that to be that it is not about us, it is about value creators. So on our website, now and in the future, you will only see companies that we consider value creators. So far, that's what we've done. Fortunately, we don't need to show many companies, so we just want to work with companies that we really like, with people that we admire, and with entities that we are sure that they're adding value, both asset management companies and listed companies. In this presentation, as I said before, Tenvalue is not about us. It is about value creators. It is not about technology. It is about people and trust. I also want to thank all of you who came here. I want to thank all the collaborators. There are so many people who have supported us so far. Some key collaborators, for instance, the Eden Global, the entity which created our website. Thanks Inigo and Angel too, because you've done an extremely good job at also not just the website, but also some key tasks for us. Of course, Alexandra and I couldn't do everything, and we count on key people to deliver some key tasks. And Alexandra and I are going to develop Tenvalue with the mission to support value creators with our data and knowledge, with our vision that Tenvalue is always going to be a very useful platform for professional investors in continuous improvement, and values that we will always keep in mind. Focus on the client, search for excellence, and social commitment. Tenvalue is an independent global investment research company. We have researched all equity funds in the European market. That was a very good experience for us, and that allowed us to understand the market very well. And having researched all equity funds, we decided to award our ratings to fund managers who have outperformed the benchmarks for the very long term. There are thousands of funds. So if you see our Tenvalue rating, that means that the fund manager has outperformed the benchmark. If the fund manager has outperformed the benchmark for more than 10 years, that's a AAA rated fund manager. If they've outperformed the benchmark for more than 5 years, that's a AA rated fund manager. For more than 3 years, A-rated fund manager. And we've also created a Tenvalue category, Tenvalue talent category, because we didn't just look at results. Fortunately, it's a quantitative criteria. So if fund managers have outperformed, it's not that we get on well with some fund managers, we don't get on that well with others and they get the stamp. No, we take into account results achieved since its inception at different firms. If average returns are higher than the benchmark, they get the rating. And then we also have the Tenvalue talent category for those investment directors who have been investment directors for less than 5 years and who we believe that they will have a brilliant future. So that's not just a quantitative criteria. We are, in fact, looking at each company, trying to understand as much as possible the product offering of each different entity, and we can also, we came up with this category that we're also very, very proud of. We are very fortunate too that I was born in Spain, in a country that we consider the European Omaha. There are extremely strong and good entities in the asset management sector in Spain, companies that we look up to like Cobas, Valor, and so on. And listening to many of them allowed us to see how good the active management can be in the sector. And then we also got to know the activities of many companies in Europe, companies like Betty Gifford, Comges, Fansmith, and so on. So we have a very good understanding on the market, and with that knowledge, we're aiming to add value to asset management companies and to listed firms. As I said before, so if you only take one message here is that we will only show information about value creators. We are very thankful and we're very proud of the companies that we're working with, both with listed companies and with asset management companies. We strongly believe that there's value in all listed companies. We could be working with more, but we decided to prioritize quality, and we will always be doing that. So we strongly like the investment cases of ENCE, Libertas 7, Global Dominion, and over time, we will continue working with more listed companies with the aim to simplify the information. Because in this market, there's so much information with our background. So Alexandra worked in a mergers and acquisition company. I worked at an asset management company as an equity analyst. I know how long it takes to understand the activities of a company. Normally, it took me more than a month to have the information as we wanted it. And there are thousands of companies in the market. So we thought, okay, should listed companies want the information to be known by asset management companies? So we thought, should listed companies pay for an independent entities to be more visible? Or should asset management companies work with a company so they have access to more information? So we're in between, and we will always aim to add as much value as possible and stick to our principles and to our values that you saw there. We will always be very focused on people. This is a business of people, so people behind asset management companies and people behind listed companies too. And as I said, also on simplifying the information. I look forward to listening to all the presentations. I strongly believe that you'll find them very, very useful. You can see also on our website, I didn't mention it, we have a search engine where you can easily identify those fund managers who outperformed their benchmarks. We have also, so first we launched the search engine and we offer distribution services to listed companies. We distribute that information across professional investors. And we also work with asset management companies, supporting them with our data and knowledge. We know that we will be coming back here in Switzerland next year, and we hope you find the presentations very, very interesting, and it's great to see all of you, and thank you so much. The next presentation is going to be delivered by Alex. Alex is the CEO at SIA Funds. SIA Funds is a Swiss-based value asset management company. Their target is to achieve returns of 10%, approximately 10% per year for the long term, outperforming benchmarks. I would highlight about SIA two different things. First, their extremely good knowledge about the natural resources market and global markets as a whole, and then also the evolution of their investment policy. I remember 4 or 5 years ago, I first watched a presentation delivered by Alex and Marcos, and I was very impressed by their knowledge and by how well they explain things. And they evolved. Marcos joined the company in 2007, 2008, so it was the best performing fund in the world from 2001 approximately to 2007, and they decided to evolve their investment policy. So they've created 4 categories, and that's worked very well, and we believe it will continue working very well. So 4 categories. Category number 1, global companies that are global leaders in their field, companies like Visa, Coca-Cola, then they expect returns of at least 10% per year. Category number 2, leading companies, which are not as well known as those names that I mentioned, but are leading companies in their fields, companies like Vidrala, Viscofan, and they expect at least 12% per year with those companies. And also cyclical companies is normally between 25-30% of the portfolio. They know a lot about the oil market, the copper market, the uranium market. And the very good thing is that they value each company. And if one company goes up and their expected returns go down, so they would buy a bit more of the company that went down, so very common sense and long-term. And category number 4, restructuring companies. And Alex is going to deliver the presentation. And thank you so much, Alex, for joining today.
Thanks a lot, Javier. I can probably save some time on my presentation because he was already describing part of our philosophy. Grüezi miteinander and welcome for the ones that traveled from outside. You find the presentation as well on your seat, on the QR code if you like. We are on purpose Article 6 fund and not 8 or 9, but we are the ones taking care in the sense that we don't want to spend a lot of booklets, printing, etc., etc. And usually when I do such a presentation, I'm almost the only one collecting the stuff after it because I'm a value guy. I want to use it again and again. So I will try to talk a bit about value and net resources to be back on track. I don't want to bore the experts in the room because we have plenty of experts. Probably thanks to Javier, I never saw more value experts in Zurich in the same room as today. I think that's quite a unique situation. Just where we are. We are at the end of the lake on this little village called Lachen where I grew up. It's a beautiful place. It's the nicest harbor around the Lake of Zurich. And because I grew up there and I belong to the old families. Also because of low taxes, but that's a side effect. And I like to show the picture of the castle. Unfortunately, it's Rapperswil. But Rapperswil is actually the castle after the guys from Zurich were burning down Altendorf, where my origin comes from, because I'm actually a citizen of Altendorf and belong to that history somehow, because my family used to go back and we were knights at the end, but poor knights. So that's why we became value investors. Now, we manage 2 funds, a value and a net resources fund. And we do that plenty years. And we have a team of 4 investment specialists, or whatever you want to call them, in our investment committee. And every of us have at least 25. I need to improve or increase this figure all the time to see how old we get. And he's the most senior guy. Carlos is getting 70 next year. And 22 years ago, I was able to do an executive MBA program with him, coordinated by the Swiss Banking School. And when I was preparing for the first school block, I was reading his last book called Strategic Logic. And I was thrilled. Thrilled that much that I wanted to convince him to start a fund with me. Carlos was doing his PhD in Harvard more than 40 years ago with Michael Porter, was then the co-writer of Harvard Cases. And I thought really he brings something to the table that is quite unique, because the book tries to explain from where is it possible that some companies can be more profitable than some others, which is the core of competitive analysis. And of course, every fund manager does that, but to a different degree. So I asked him 22 years ago, and then he smiled and told me that I was 4 months too late, as he started with a fund project already at that time. But he said, "Psst, don't mention it to anybody because I'm still formerly a professor." So that is an important person. Urs is an interesting character as well. Urs, I was able to bring back from early retirement at 45 for an annual salary of 8,000 Swiss franc, annual salary, because he was very successful in the previous commodity cycle from 2001 to 2011. His fund got, Felix Zulauf of Gondwana fund got from 5 million to 1.5 billion. And then they said the story is over, Glencore goes to the stock exchange. If the professionals like Glencore sell at the market for a very nice premium, maybe the commodity cycle is over, and it was. So I was able to bring him back 15 to 16 because our natural resources fund was so close that it was barely at the minimum. And we had to decide either we close it at 5 million or we give it another try. But all of you know in the room that if you're down there in assets under management, maybe there's a chance that the cycle comes back. And that's actually what we try to do. And in the meantime, this fund is now close to 100 million US. Last but not least, the most important person is our Chief Investment Officer, Marcos Hernandez, who actually apologized for not being here. He's extremely busy today. But he's actually joined us, as you mentioned, in 2008, actually, in February, before the thing went south from our fantastic starting story. He's very experienced as an analyst, and he's now basically, since 2019, he's the one leading the portfolio management role. You're not in the wrong presentation, because that's the current pick that is pushed through the village. I used that slide already a couple of times. George knows it already. But I still like it because a lot of investors are just thrilled with the fashion name, etc., etc. And I like to ask people, do you remember your first internet provider? In my case, it was 95, it was CompuServe. There were 150 of those. Not one single one ever made money for the shareholders. So watch out that you're not in a similar situation if you invest in that space. Now, ChatGPT I use since last week even as a pro with a $20 payment per month, because I saw that there is really some good stuff there. For instance, just before the presentation, I checked how much more electricity you need for a ChatGPT search than a Google search. Because I was listening this week to a lady talking about that subject, and she mentioned 30 to 40 times more. ChatGPT themselves, they said their answer was between 10 to 100 times electricity need for a ChatGPT search. So my conclusion out of this exercise is energy, 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 or electricity, electricity, electricity. The last pick that was pushed through the city was this one, autonomous driving, but not with these pictures. There were autonomous driven car, taxis are now there. Yes, it takes place, but it takes much, much longer. But are they profitable with it? Not sure. But these guys at Rio Tinto, they are profitable. They are saving 190,000 Aussie bucks in the outback in Western Australia, where actually, yeah, they can save it. So in other words, maybe you end up making money in AI, robotics, autonomous driving at a space where you will not expect. And that was just a short intro. Now our value style, like many value styles, focus on similar things. Obviously, everybody tries to buy good business, good management, good balance sheet, and then finally at a good price. Why do we call ourselves, our investment style, strategic value? Because we think it's important to really understand the positioning of a company. Now, a lot of blah, blah, blah. By the way, another interesting note is, I learned yesterday evening from my son, there's a blah, blah, blah index, a bullshit index, where you can put in a text and then it quotes how much, probably it was created by ChatGPT, and then it detects it. So they are very interesting things. But here I think it's important to see that what we try to do. And I like to use these old examples. Some of them, some of you have already heard, but it's important to realize, and I think it's a good occasion to explain what we try to do. Devro is the number 2 in the sausage skin market. There are 3 players in the world, the third being Chinese. So we bought the two others, Viscofan, the Spanish no, and Devro. We detected relatively early. They were bought by a German family. So in the case of value, everybody usually asks us, yeah, but what's the catalyst? Who is going to wake up this name? And maybe you don't need a catalyst from the market. Maybe it's Mr. Private that comes and buys. That was the case for Devro. We bought it at the P of 6 or 7 because it was purely managed. And then they had a CFO first coming from Unilever. He became CEO, and then it happened what it happened. Butzi, a very interesting story. Some colleagues of that are here also understood it exactly as we did it. It was trading at price to book of 0.6 first before we bought. That was then last year. And this year it went to 1.1. But 0.6 price to book, debt-free, how can that be? It can only be if there are crooks. There are Italians, but there are no crooks. The reason is because of ESG. No large investor in Europe was able to actually buy cement any longer, not realizing that you need 1,300 cubic of cement in the foundation. So you have heard the story probably several times, but we made use of that. Now it's a bit expensive for our taste because for a cyclical, we expect to make 14%. It's now 11 to 12. It's still a fantastic company. And they do a lot of things like carbon capturing and et cetera, et cetera. So it's totally misunderstood. And we think it's about to change the way people approach ESG, and hopefully so, because it's done in the wrong way. Uranium you mentioned, I mean, 6 years ago when we bought it, it was from the devil. Now it's green. It's now neither black nor green, it's gray. But the sentiment is changing. And the last example is just a crazy situation of an oil company in Canada called Cenovus. It's one of the top 3 oil sand companies in Canada. They are now debt-free by now, and they decided to pay now back 100% to the shareholders, the free cash flow, in form of cash buybacks and dividends. And they have even had an investor slide deck last November, a year ago, where they showed that the $75 oil price, I know we are below today, on average they create 33 billion of free cash flow, which was equivalent of the full market cap a year ago. Now the market cap is 39. Now you could say oil will never be there. We have a clear view, and I'm gonna come to that in a minute, that the oil price will rather go up than down. But even inside this market, they will be highly profitable and buy back their shares. That's the long-term 10%. That's that we try to achieve, which is basically good relative to other value guys, with one exception in Switzerland. There is an exception that did 15% since 2008, but we are at 10, and we are happy to have that. If we look at our see-through profitability, as Warren Buffett calls it, we have an average P of 11.5 for the fund with these 4 categories. That's on Bloomberg average, mean average estimates. 3.2% dividend yield and 1.8 time price to book. Now, you mentioned that maybe it could be interesting to have an investment case. We can go through it maybe very, very fast. ISS, I don't know how many of you know the story. Some of you have heard the story already. To me, it's just a sausage skin example in a different way, because I think Ermotti is proud to say that I'm not making more than 40 times the cheapest employee of UBS, because the cheapest employee is not any longer the cleaning lady, neither the cook, because it's outsourced. So the big tendency from the big international multinationals to outsource this not important stuff, and then there's room for these guys. Look how diversified they are. They're everywhere. I mean, the guys that flew in, not when it was dark in the morning, but maybe when you fly out, on the Zurich airport, you see the ISS trucks driving around. And not only here, all over in the world, also in technology, they are 3 out of the top 5 are their clients. They are in hospitals, etc., etc. We own not only one. Like in most cases, we like to operationally diversify. So we own Sodexo, a competitor, and Compass Group, which is basically, out of 4, we own 3 of them. The largest position, though, is actually ISS. Operationally, they turned the corner since COVID. They have very nice expectation. Of course, expectation, we know all about what that might be. But look at the share price. The share price is still at COVID or close to COVID low. Why is that? To me, it can only be explained because we are in the finance industry and we think, okay, home office leads to lesser cleaning jobs, lesser kitchen jobs, etc., etc. To me, that's banking space is part of their business, but not the full business, one. Second, there's going to be a fight for talent. So you maybe end up by having table tennis and whatnot in your bank organization or a daycare or a fitness center. Does that needs lesser cleaning or more cleaning? So I think you can give the answer yourself. And a chart that I like to do a lot is the following chart, where I show the operational earnings of a company, which are these dark blue lines, and then here the light blue, and then the share price. And you see the share price is massively depressed, rightly so, because basically down here the earnings were dropping like a stone in 2020. But now the analyst expectations are up here, which is pretty much out of whack. A P of below 8 next year. Historically, a P of 20. Free cash flow yield of 12. They start to buy their shares back, etc., etc. And now this one, I filmed myself with an iPhone in 2019 at the Prague airport, ISS. So they were able to cut their workforce from 510,000 to 310,000. Food waste, they were able to reduce by 30% since 2019. Why? Because if you do the batches in the morning, they know who is in the Credit Suisse building, or who was better, and then they cook it accordingly. And I think that's pretty clear. If I may add how I'm untying, maybe 5 minutes on natural resources. That's a chart a lot of you have seen already. That tries to measure the commodity prices, so not commodity companies, but commodity prices as a ratio of the S&P 500. And we are basically at the bottom, close to a 50-year low, or almost at the 50-year low. Now, because it's a ratio, it of course has to do as well with the S&P. So we do not believe that the gap will be only closed from one side, the gap will be closed from the two sides. But we clearly see here this phase where Urs was already once successful. He thinks, and we are convinced, that we're going to see a similar development. Maybe if it just goes here, it's a massive magnitude possibility, and that's what we basically are expecting. Now, just because prices are low, or in a ratio are low, why should it now change? Commodity markets are long peak cycles. So it's very important to monitor what happens on the supply side. And this chart shows in dark blue line the CapEx, inflation adjusted, that goes into energy. And the light blue line shows the CapEx that goes into mining, industrial mining. And you see it quite an extreme picture that here since 2014, this has dropped like a stone. And the impact of that will be massive, because the last mines that went into production last year or the previous year, being it in Congo from Ivanhoe or being it from Olitoigo by Rio Tinto, they have been financed 14 years ago. So you always have a time lag of 10 to 15 years, which is massive. So now, dark blue line, it's clear, we don't need energy anymore. In 5 years, everybody will drive electric, so forget about it. Yeah, but if that would be the case, we would need to invest in light blue like here. Because I can calculate, if you want, that we do not have enough copper to electrify 10% of the global car fleet. It's not working. Because a global car fleet to electrify 1.4 billion cars would actually mean that you would need 12 million tons of extra copper. And the current copper demand and supply are 24 million, decreasing. Why? Because of that. Because when you have a Volkswagen plant and you produce Volkswagen coming out, it stays more or less. Of course, you have to pressure the machine and make sure that the oil is there in the machines, but that's it. A mine gets empty every year, 3 to 4%. And that creates this massive cycle when it then turns. We like to invest in commodity companies and not in, because you can also invest in the future directly. That has some issues, and that's why we prefer companies, because the companies are so attractively priced today that you do not even need to bet on a rising price. But of course, if you have a price jump of the underlying commodity, then you get it extra. We do not invest in precious metals, because we think there it's difficult. It's very difficult to industrially really produce for 30 years gold or silver. By the way, silver doesn't even exist on itself. It's always a byproduct of something else. And usually when you have to, when you tell your investor, yeah, we just have to go underground after 5 years, your costs go X-wise, and that's why it's a total different cost structure. We really like to buy commodity companies that are undersupplied and stay there for a long period. We don't buy exploration companies, and we really want to buy companies that generate free cash flow and give it back to us. Again, that's a picture of the Natural Resources Fund since the COVID low, which is an extreme moment. So we can show basically that we have high beta, also on the way down, obviously. But on the way up, it was very nice for us, and we were able to beat basically the index here in the Natural Resources Index by more than 100%, because this one, it consists mainly out of the large oil companies, and specifically European ones are massively politically managed. Maybe ask ChatGPT next time the turnaround that BP did 3 weeks ago, because until 3 weeks ago they said oil is not going to be needed in 5 years. Now they totally changed and said oil is going to be needed. But they sold all their oil assets to fantastic companies that we own, and they don't have anymore. But they have some wind parks and some other gadgets that work sometime when there is wind. And yeah, I think that's it. Thanks a lot. I hope I was not too boring. Questions at the end, or
yeah.
At the end of everybody? Or?
No, yeah, you can later questions for it. Good. The next presentation is going to be delivered by Urs, Fund Manager at Arfina. I'm going to start with a brief intro of Arfina. So Arfina is a Swiss-based boutique company. A group of finance professionals joined forces over 10 years ago to create Arfina and offer both wealth advisory services, wealth management services, and asset management services. In terms of the asset management company, asset management side, in terms of the fund offering, it's very impressive how well they've performed with Swiss equities, Swiss small caps in particular. So Franco Cortesi is co-managing the fund with Urs. Urs joined Arfina recently, and they've outperformed the main benchmark of Swiss small caps every year since it started. So for a year, for 3 years, and since inception, they've been able to manage to outperform the main benchmark. I could speak to Franco and his colleagues some years ago, and I was very impressed by how much they know about our company. So they meet the management teams. They are people who really like what they do, and they're very passionate about investing, and I strongly believe that their future will be also very bright. Urs is going to speak now, and thank you for coming.
Thank you very much, Javier. So hello everybody, thanks for spending the afternoon with us, and yeah, you'll hear many different things. Swiss equities now, that's actually all you need, but I'll show you why I think it is like this. So well, I thought it's 10 minutes, but yeah, I'll be pretty quick on that, so there's room for Q&A, definitely. I first would like to show you why we think Swiss equities should be a cornerstone in every investor's portfolio. Then specifically small and mid caps, what's especially interesting about this section. And finally, why I think we have a pretty interesting offering that you should, sorry?
So the screen can be seen.
Yep. Well, why you should consider Arfina to be on your menu when you are convinced that Swiss equities should be part of your portfolio. So very quickly, Switzerland, what makes it interesting? Well, we're here in Zurich. I don't want to spend too much time on that. Let me just pick out two things. That there's one natural resource that we have here in Switzerland. The only mining we can do here is brain mining, so it's brain power, it's innovation. You rank it by whatever you choose, patents per capita. Switzerland is leading by far, by hugely to everybody else. We have this educational system here, so it's a lot of very smart people here, many innovations, good universities, etc. The second is obviously the Swiss franc. Plot the Swiss franc against any currency of your choice in the long term. It's an easy one. You want to be long the Swiss franc. If you invest in anything else, convert it back to Swisses, you better start from the very early point to be long in Swiss franc and all the other things that make you being here in Zurich. The black line is a 24-year chart of the SPI, so the broad market in Switzerland, large and mid and small caps together, versus MSCI Europe, world, global. So it's against, and some think US is the holy grail, while Switzerland is actually doing better in the long term. Now take exactly the same black chart for the next slide. And there is still something which is better than that. And this is the small and mid cap space. The small and mid caps in Switzerland, there's a main difference versus the big one. Switzerland is known as being a defensive market, as the large caps are dominated by Roche, Novartis and Nestle, defensive sectors, pharma and food. While in the small mid cap space, 30% is industrials. It's much more cyclical than the large cap space, which has only 10% in industrials. So that's one main difference. And then obviously they're typically at the earlier stage of their business life, that there's typically more growth opportunities for a smaller company than there is for, well, think of Nestle doing not that great over the last couple of years. So in numbers, close to 5% per annum over this 24-year period for the broad market in Switzerland, and it's more than 7% for the small mid-cap space. So the numbers themselves are pretty impressive. The last 2 years, honestly, not that impressive in the direct comparison, but if you really look at the long term, you see that there is a strong outperformance that small mid-caps can deliver. And you get an international footprint. If you invest in Switzerland, you get a very international portfolio. Just imagine, it's the geographical size of Switzerland. It's so small that the company at the very early stage in the life of the company comes to the physical border. So typically you go international much earlier before you get a listing at the exchange. So pretty much every company listed at the exchange, couple of exceptions like Swisscom, for example, not even them. But typically a Swiss company is very international. You see, even in our space, it's less than a quarter of the turnover is generated in Switzerland. We could not eat all the drugs from Roche and Novartis, who are permanently behind. So very international portfolio that you get a lot of diversification just by having a Swiss equity portfolio. A few words on Arfina Capital. Javier mentioned it, founded 10 years ago by these three gentlemen coming from Credit Suisse, then serving Swiss and Spanish clients. We got all the FINMA licenses you want, especially the one also for collective assets, which allows us to run funds as well. So the two people managing the Swiss equities, while our colleagues are sitting in Zurich, we have an office in Tenvalue. Franco started this fund I'm talking about 3.5 years ago. More than 20 years experience, very well educated, 20 years in Swiss equities. We're the same age. Also myself, 25 years plus experience, always in Swiss equities. And I think that's a big part of why we've been quite successful so far is just the experience that we have. We've done every mistake. We're both 53 years old. So all these psychological traps the market offers you, we've fallen into them maybe a couple of times. We've been too aggressive, we've been too passive, we didn't sell the losers. All these things, you know, it's hard to get rid of losers because you still have this anchoring thing. You know you bought it at 100 and you should sell it at 50, but it's so hard. And you have to take this pain a couple of times before you decide not anymore. So I think we learned a lot. And Mr. Porter has been mentioned in the last presentation. I think our process, it feels like Porter's 5 forces plus. There's more to it than the the situation of the market and your market position. And a very important point for us is always management. That's the top priority. Of course, we look at the business model and we analyze it and we say that that's the growth potential, that's the margin potential. But then the big question is, do you have a management team in place which is able to exploit that potential, or will they not? And this is the beauty and why we're so passionate about what we do. We're very close to these companies. We invest in Switzerland, we sit in Zurich. We know these guys. We know our 100 CEOs we would potentially invest in. We invest into 30 to 40. We know them, we meet them regularly. I spent tomorrow a day with the management team of Inficon, for example. So we're very close. I think there are many funds out there invested in Apple. They might not be so close to Tim Cook. We know our guys. So maybe I'll give you a specific example. I didn't prepare numbers on that. But let's go for our biggest bet at the current situation. That's Surveillance, a company that does testing, basically, certificates. If you need an ISO certificate on how green, how efficient, how whatever you are, if you need a certification to import something from outside of Europe into Europe, if you need this CE stamp, you need to get that from an official company. And Surveillance is one of the leaders, together with Bureau Veritas or with Intertek. And Surveillance has been the most complicated organization left in Switzerland, the last matrix organization we had in Switzerland, I guess. Now we have a new manager. She used to be the CFO of Holcim, another big position of ours. And I would love to talk about the cement space as well. Now, I completely agree. We went from ESG 1.0, it's bad, to ESG 2.0, it's good. Same company. So this lady having this experience with Holcim, and we have the experience with her. She's bringing the same toolkit to a new company. She's cleaning that up. She's harvesting the low-hanging fruit. We have a lot of good experiences with her. And we see the business model is there. We see how well Bureau Veritas has done and Intertek. And Surveillance has missed a lot of these opportunities under the old management. So management change is potentially a very important driver for us. And this is the specific case right now. So we see the sentiment change coming up. I also think trying to have a feeling, a nose, an understanding, experience what for sentiment change is very important. We run a 40 million fund. We will never influence the price. It's the 99.99 other investors. So we have to have an understanding, when is the sentiment changing? I mean, if a stock is trading 10% higher today than yesterday, it's typically the same company. It's typically sentiment changes. It's emotions that drive the market. So again, experience quite important. Results, Javier has mentioned it. The green bars show the outperformance per year. So in every single year since now, it's not that long, honestly, 3.5 years. But we've been outperforming in every single year so far. And I especially like the thick one here. Why? It was a down year. And many small mid-caps funds out there are high beta funds. And we really try hard to be pretty exactly at 1.0 and just deliver alpha. We want to beat the benchmark. And I think for most clients, be it private person, be it pension funds, it's even more important in a down year that you beat it in that year. And so far, yeah, it's been successful. This year, with a good start in November, it's like 1.3%. What you see here is the net result of the most expensive share class that we have, 1%, the retail share class. So add 50 basis points every year if you qualify for the institutional share class. We're pretty happy with what we've done so far. And with that picture, which I think is the most important one, I'm happy to take questions if we do it right now, or if you want to do it afterwards. I'm ready to hand it over to your next speaker.
I have one.
Yeah.
When you say small and mid cap, small can be 0, mid can be big size.
How big is it?
How small it is. I mean, do you have something like my burger in there?
Oh God, no, we don't invest in companies that do 11 loss years in a row. Okay. So we want the minimum quality. But in terms of market cap, yeah, it can go pretty small. I mentioned, so what's the restriction limit? Basically, we want to invest less than 30% of our assets into companies which have a market cap below 1 billion. So that's one thing. In Switzerland, typically, the definition of what's a large cap, what's a mid cap is the 20 largest names, the SMI. These are, it's just the number, 20. These are the large caps. And typically, it's around 10 billion market cap only, what you would probably consider a small cap in the US. Here, from 10 downwards, mid cap starts. And then again, the definition is they are, is it 20 or 30 mid caps, and the rest is then small caps. So it's the number. The smallest we would invest in is probably around a couple of 100 million market cap. And this fund will never be a 1 billion fund. So if we have the greatest success we could dream of, we will close at least latest at 300 million, not to make our investment universe too small.
Any other questions?
Thank you very much. Thanks, Javier.
The next presentation is going to be delivered by George, who is the co-founder at VWM Value Investing. VWM Value Investing is an asset management company which was set up in 1997 with the goal of achieving very good long-term returns for investors, capital appreciation, and they have a value style bias. They've managed to surprisingly outperform the benchmark for the very long term since inception for around 2% per year. We've seen just a very limited number of managers all over Europe who've been able to do that, and that's why they've received the recognition of the AAA rating by Tenvalue. We thank them. Thank you very much for joining us today, and yes, he's one of the best, also as the others who came for many years in the market, and I'm looking forward to listening to you.
Well, thank you very much. Do I need to do anything, or?
Yeah.
So, well, that was the key slide, so now you've seen everything. Okay, so I'd like to introduce our firm and how we work quickly. We're value investors. We manage 2 funds, and what we do is value investing, because that's what we do. We're value investors. So we're fundamental value investors. We look at the companies very carefully. We are stock pickers. I'll talk about that quickly. I'll give you an illustration of a typical holding. Sonai, it's a Portuguese conglomerate. And then I'll give you just a little marketing pitch about how wonderful it is to be a value investor today, even though it hasn't been wonderful for the last few years. So how do we work? Well, as I said, we manage 2 funds. The Classic Global Equity Fund was founded in 1997. Classic Value Equity was founded in 2004 because we had to soft close the Global Equity Fund at the time. They both do essentially the same thing, but the Classic Value Equity does not invest in small caps, which we define as companies with a market cap of 2 billion francs or less when we buy the first share. What we're trying to do is put together a portfolio of 25 to 30 stocks by understanding the businesses carefully and buying them at a discount. So we're looking for a high margin of safety based on normalized figures. I'll go into that in a second. We're engaged investors. That is, we talk to our companies, we write them letters sometimes if we feel like that's necessary. So we're very close to them on every level. Now, how does what do I mean by normalization? It's quite simple. We tried. Well, it's a long process, but theoretically it's simple. We study a company's history and its competitors' history to know to get an idea of what the normalized level of earnings is. typically a value stock is cheap for a reason. It's usually under pressure because something's not going well, it's not earning as much as it should. So you want to know how much do they earn under normal circumstances by studying its history, by looking at the competitors. That gives you an estimate of what's possible in the future. And then we say, okay, let's say that we go back to this normalized level. If we think that's going to happen, what would be the normal multiple? And again, you get that by studying the history, doing a discounted cash flow analysis, all of the basic tools that securities analysts use. Mechanically, we say in 3 years we reach normal earnings. In 3 years we reach a normal multiple. Then we discount that intrinsic value back to today. And that's what we think the stock is worth today. And then we buy at 60 cents on the dollar, roughly. Sometimes we pay a little less, sometimes more. Depends on how risky the situation is. The heart of the process is research. Most of what we do is research. We do building our own financial models, talking to the companies, talking to competitors, to ex-employees. The idea is to get a good sense of what the numbers that you're looking at mean. The numbers are the starting point, but you want them to tell a story. You want to know the story of the company. And you can only get that by understanding what people have experienced, what has gotten us to those numbers. And then we value each company in the process I just described. Here's our performance of the classic global equity fund since inception. So you see we had a wonderful phase which ended about 10 years ago. It's not been a fun time to be a value investor. We've been going sideways, but as I'll show you at the end, I think that's going to change soon. Let me give you an example of how we think. I'll skip some of the slides because I don't want to go into too much detail, but the company is Sonai. It was built by the De Azevedo family. The patriarch, who's now out of the business, bought the company in 2000. All it did was wood panels at the time. He then diversified it. He did what you're not supposed to do, buy lots of different businesses. And in the meantime, this chart shows you what we think is the intrinsic value of the various bits of it. You've got retail, you've got electronics, you've got real estate, you've got telecom. This is one of the largest companies in Portugal. It's the largest employer in Portugal. And they have their fingers in a lot of pies, but they're good at it. Their main asset is Continente. That's the largest supermarket chain in Portugal. This is the best supermarket chain from what I understand. It's got the best selection, it's the freshest products, it's got the best distribution, and if you have a loyalty card, it also has the best prices. You pay less here than you would at Lidl for your groceries. So it's a very successful company. Show you that with a couple of charts. It's been growing at 7% per annum. Since 2013. That's very good for a supermarket. We'll see that in a minute. And its margins, EBIT margins, are at about 5%. How does that stack up to the competitors? Here you've got all the names that you know. Sonai is the solid line, and then the dashed lines are the various competitors. And you see that it's been growing very, very well, considering that this is all organic. Here we've just taken the sales of the competitors, so any M&A that they've been doing would also make those lines go up. So this is a growth business, also because, of course, Portugal is a growth economy. The margins in international comparisons are really good. Actually the best at the moment, normally one of the best, showing how well managed this company is. Okay, now what's the key then over the long term? For us, it's the value creation, that they make money with this thing. So let's just take an increase in book value of Sonai. Now we're back at the entire conglomerate, right? Book value's gone up nicely, but if you do a Buffett return on equity, which is you take the change in book value plus the change in, and you add back the dividends that have been paid out, you get that they've posted a 9% annual return for the last 15 years. 9% is pretty good. It's not great, but it's good. And this is just the book return. Obviously, there's going to be value created on top of that. How do they do it? Well, they run it well. I showed you that. And they're also good asset traders. They just sold 25% of Continente, which would be MC Sonai. That 25% gives us an implied valuation for the 75% they still own, which is larger than the market cap of the company on the whole. So you're getting all the other assets for free. But they do a lot of transactions, so they're good operators and they're good asset traders. And here's the valuation. Here's the price to book ratio from top left to bottom right. Now, the way we work is we give every company an intrinsic value. That's the solid line. Then to give you an idea of the contingency of corporate earnings, we also estimate a high and a low value. Makes us as analysts aware of risks and opportunities. And you see that Sonai has been trending sideways even as it's built value over time. So it's one of those situations that hasn't worked out. This has not been great for performance, but it's wonderful value creation, which as an investor is where you want to start because you know that eventually the market will catch up. And I think it will catch up because stocks in our part of the universe, cheap stocks are really, really cheap right now, especially in Europe, where we're about 80% invested. On the left, you have the MSCI indices for growth and value in the United States. On the right, Europe. In blue is growth, so expensive stocks. Green is is value, and in every case, we're showing you the PEs, the forward PEs. And you see how the US is very expensive on the growth side and is kind of expensive on the value side. Here, Europe as well, you've got a big gap between growth and value, a gap that's much larger than what you used to have. But value stocks have gone sideways in terms of valuation. And that says to us that this is a wonderful opportunity. Another way to look at this is to have the ratio of large and small caps PEs. Again, on the left, United States, on the right, Europe. You see there's an enormous gap between expensive and cheap, 2 standard deviations from the mean. You know that's not sustainable. All of us know that mean reversion is ultimately what drives a lot of the financial markets. So with all that said, a quick look at our portfolio. Just to show that we really are value investors. This is our estimate of price to intrinsic value for the portfolio as it stands. So if we're right on all of our companies, you're buying them at 55 to 60 Rappen on the franc, 60 cents on the dollar. But if you don't believe us, if you think that these numbers are made up, here's the Bloomberg numbers to prove, just to show you where the multiples stand as an average for the portfolios. And you see that we're about half as expensive as the MSCI in terms of PE, and less than half in terms of price to book. And at the same time, you've got high dividend paying stocks, which is tax inefficient and not something I like, but it is an indication that these companies are healthy and unfairly cheap. That's it. As far as our presentation goes, if there's any questions, I'm happy to take them.
Can you trace back your value approach into how it was first created? You know, there is this Columbia University, Graham and Dodd, Warren Buffett type of view. How do you form your own philosophy? How does it compare to the classical value?
I'm sorry, I don't quite understand the question. How does our approach differ from the classical value?
Exactly.
It is classical value. It's very boring.
No, but for example, you look at sales or as secret sauce, or actually more like what type of company you look at as opposed to...
Well, we avoid certain businesses because we don't think they're very interesting or very good. So you want to look at capital returns over time. But we're not, I'm not going to say we invented anything. We didn't. But our style does. We do avoid certain bad businesses if we think that over time they're not going to create value. And of course, the basis of the valuations is the cash, the ability of the assets to generate cash. But sometimes that, if it's, let's take a building that's not rented out, its ability to generate cash will be if it can be rented out, or if it's demolished and something better is built in its place. So but ultimately you want to know how much cash something will generate because that's what we're paying for as investors. Everything else is, that's why gold is not interesting for us.
There was another question.
One question. These Portuguese companies looks very interesting. What's the main reason why you believe it's so cheap?
Yeah, that's always the hardest question. Why is it cheap? Because you look at it and you say to yourself, this is stupid. Well, I guess there's a couple of factors. Number one is it's in Portugal, and who invests in Portugal? Number two is it's a conglomerate. We all know that conglomerates are bad. Yeah, that's probably it. I mean, it takes a little bit of work to understand it. It's not that big. So if you're going to spend a lot of time taking apart a conglomerate, then I suppose you'd rather do a really big conglomerate. On the other hand, it's a European company, so you have good disclosure, not like in America, where the disclosure is terrible. Yes?
I think you said you were trading on the sideline and you were expecting this to change. It's painful to be a value investor and you expect that to change. What do you see in the environment that will build the case for value investing?
I guess if the factors that have caused value to suffer for so long were the super low interest rates. So that's over. We're back to normal interest rates, even though most young people don't know that for them this isn't normal, but for old people like me, this is normal.
4 is even low still.
Huh?
Still low, 4.
Yeah, maybe even a little bit low. Whatever, but basically we're talking about a normal level of low to high. It's not crazy. That's that. Then there's the trend to passivization. It's sucked a huge amount of assets out of our investment style, out of active value investing in particular, because it's underperformed as a style. It's a salesman for a U.S. value company said, I go to the young guys, they know that value is dead. It's never going to come back. Forget it. It's over. And we've had huge outflows over time. That's forced us to sell value stocks, which caused those to underperform. It became a vicious circle. I think that's pretty much over. I don't think there's much less either that or we go out of business completely, all of us. But we're all fairly small compared to where we used to be. We're completely out of fashion. There used to be lots of books about value investing. When I was young, you read lots of books about value investing. Now they're all about quality growth investing. That's what's being published. Chancellor just had a nice presentation on that a couple of weeks ago here in Zurich. Everybody wants quality growth because we know that's what's the right thing to do. Value's out. And then the last factor is, what have I forgotten, Urban? The interest rates, the passivization.
Valuations effectively becoming cheaper.
Yes, that's right. The mechanics of value investing. The GMO took this apart for nicely. You've got, well, Urban, you explain it. It's your slide. This is my colleague Urban Müller. He used to work at GMO.
Okay, I'll go ahead. Didn't prepare for this, but that's okay.
You know it.
So basically, one thing you can do is you can do a return decomposition of any return, and if you do that, you basically have dividend income, you have earnings growth, and you have a multiple expansion or contraction factor that all adds up mathematically to total returns. You do that for value type stocks. What you realize is that the mechanics of value investing, the dividends are still being paid, the earnings growth isn't great, that you wouldn't expect that for value stocks, but that's continued. The one thing that you can really observe in the time series of US stocks and European stocks is that valuations of value stocks over the last 10, 15 years have continued to go down. It's been particularly pronounced in deep value, i.e. very cheap value stocks, where the main factor for its underperformance has been earnings multiple compression. And so we do think that there also some law of gravity will apply, and that multiples cannot basically compress forever. Now we should, clarify that we're talking about value investing of which considers quality. We certainly don't ignore management quality and other aspects, but the value segment that's been doing particularly poor has really been the very cheap, deep value type of stocks that we like to fish for in our portfolios.
And it's what Urban was saying before, is for value investing to work, you needed to have cheap stocks become more expensive over time as people discover the undervaluations, and that mechanism has just simply stopped. And so now you've got relative valuations for cheap stocks versus expensive stocks that are just completely crazy by historical standards. And so I think that, I don't know, we've had craziness for a number of years. We'll probably have another 4 years of craziness ahead of us in America, in politics. God knows what'll happen, but it's probably a better bet. I would say if you're going to place money going forward, you have to put some money on mean reversion in this mechanism versus just betting that NVIDIA is going to dominate the world of AI chips forever. It just doesn't make sense not to do at least some value investing nowadays.
Thank you.
You have time for another one.
We'll leave it to Javier, or otherwise we can answer during the break.
Yeah, you can answer during the break for the next one.
Thank you.
Francisco Burgos, Head of Investor Relations at Cobas Asset Management, will be the next speaker. Cobas Asset Management Company, Cobas Asset Management was set up in 2016. Francisco Garcia Parames is the co-founder of the company. He achieved returns of 15.5% per year since 1993 to 2014. And Cobas Asset Management Company, Cobas Asset Management has stick to the investment philosophy that led to those outstanding results by Francisco Garcia Parames. They pay as little as possible for the free cash flow generated by companies. They buy businesses with low debt, with good levels of margins, good companies, and they wait patiently for the long term. And Francisco will also briefly speak about Palm Harbor. So they also partnered with Peter Smith, who also has the same investment philosophy with flexibility also to invest in small caps. And we also believe that Peter is doing an outstanding work. We could meet Peter and he's very also enthusiastic about investing. He has the right mindset to stick to his investments for the very long term. And we think that the best is yet to come for both Palm Harbor and Cobas. As it also happened with some other presenters, with this value style philosophy, paying as little as possible for the current cash the company generates. The last years were a bit tough, and also especially with after COVID, some sectors that they favor were struggling. Companies in those sectors were struggling, and we believe that after normalization, the next years will be very positive for them. He will explain what they do, how they do it, and why they do it. Thank you.
Hi everybody, it is a pleasure to be here with you. It is a pleasure to be in Zurich. My grandfather used to live here, so it is a special country for me. Thank you, Javier, for letting us be here. He's a partner for a long time, and we're happy to work with him. My goal within these 10 minutes is to let you know how we apply the principles of value investing and why it is a good choice for your portfolios. So, we are an independent company. The employees of the company are the biggest investors in our funds, okay? And we're specialized in small and mid caps. That means that we will close our international strategy in 5 billion and our Iberian strategy in 1 billion, okay? We are fully aligned with our co-investors. That is mainly because we are one of them. So this is a story that started at 30 years ago, okay, where the investment team were able to deliver an 11.7% of annualized returns, including these years in Cobas Asset Management. I would like to say that we were able to deliver these returns because we are smarter than the market, but sadly, at least in my case, it is not true, okay? Basically, what we look for in companies, how we do it. So we look for low disrupting risk sectors. That's why we have this industrial bias. We like companies where there is a group of control or a family, because that means that there is skin in the game. We look for companies with competitive advantage. That's something we can feel with the roses. We look for companies with a strong free cash flow generation that grows. That we look for companies that grow it on year-on-year basis. That is like happens with most of the names in our portfolio, and where we have a visibility for around 10 years time. We want to have the time on our side, okay? And we look for all these things, trying to pay the little for these companies, and of course with a little leverage. And this is the team that they've been working together for a long time. The methodology and the process that let us have this good performance in the past, it is because of these guys. Francisco García Paramés is the leader of the team. He's the CEO and the founder of the company. And the rest of the guys have been working together for a long time. I would like to highlight Minkun, that he is covering the Asian market, and he's been working with us for 17 years now. Okay, so we look for value in all the countries and in all the world, but we want to be close to the names where we invest in it, because being close of the companies is something very important for us. Even being Francisco the leader of the team, all of them are co-portfolio managers, okay? They have to come up with new ideas for the portfolios. So if one of the members of the teams find a new idea that they developed a model, not that detailed, where they're trying to find if it gives upside and quality to the portfolio. If he thinks so, he shares it with another two members of the team. One of them is going to be Francisco García Paramés, and the other one, they will look for synergies, because they're generalists, but they have some specialization on some sectors. So they go in depth in the quality and in the quantitative side of the model. They vote for it, and it goes to the investment committee, where all the members of the team got to prepare or to study this new investment thesis. And if they agree, and if the majority of them agrees with the inclusion of this name, we will invest into it. And we will invest with a weight of a 0.7 to 1%, not over that. And if we don't tend to concentrate, we don't have any fear on concentrating, but we have to spend time on this company in order to know more about this company, know more about the management team, know more about if the projects are being delivered well, and also because we wait for the new windows of opportunity. And if we find eventually a company where we think that the free cash flow generation, it is very difficult to be reduced, we can concentrate, if we believe in the company, for over 4.5%, 5% onwards. Okay, we have currently a couple of companies only with over 5%. Okay, but the top 20 companies in our portfolio weighs around 60% of the portfolio. So this is our portfolio. As I was telling you in one of the first slides, we look for high quality companies. There you have a ROCE of 34%. These companies are trading at 6.6 times PE. We have time on our side. As you can see, it's 5 years. The companies we invest in are generating what we've paid for them. So times on our side, if the market do not pay attention to them in 1, 3, 5, 7 years, they're creating value for us. And lastly, the EBITDA. Our companies are deleveraged. They have 0.2 net debt EBITDA ratio. So there is not a risk in our names. During the last years, we had a very good performance. Due to the nature of the companies we invest, we tend to have a very solid performance, and we go with the benchmarks. And some years we have this difference in terms of performance. So as you can see, in 2022, we were able to deliver close to 10% of performance, while the market was dropping in all the asset classes. 2023, the market rebounds, and we're not that far. And this year, the performance has been quite good because some of our top names are starting to get into the target price. The market is paying attention to them. But still, we have a long way to go. We've been invested in our top 20 companies for almost 6 years now. So the level of conviction in all of these names is absolute. And we have a portfolio. The window of opportunity is so good because the portfolio values 2.4 times more than the price, than the market says today, than the NAV of today. And what is the structure of the portfolio? Well, our colleague Alex talked about the opportunity that there is in the energy sector. We invested a long time ago and we earned a lot of money into that. What we basically do is we tend not to invest in commodity business related businesses because we don't know what the price of the commodity is going to be, so we cannot have this free cash flow visibility. That's why back in the days we started to invest in LNG infrastructures, contracts with over 20 years time, so we know all the free cash flow generation that they're going to have. We invested in engineering of oil and gas services because we knew that there was a lack of capex in the sector, so we put money into that, and still we have some money there. And one of the only changes we've made since the launching of the portfolio was the investment on oil and gas producers. But normalizing the price of the oil at $65, they're trading at 3-4 times. So we don't have this visibility in terms of free cash flow, but in a few years they're paying they generate what we paid for them. So the analysis here is based on the corporate governance. Does the company pay when they're in good times, or like other commodities companies, they do not share in terms of dividends, share buybacks with the shareholders. In some words, are they aligned with them? Then we have 32% in defensive names that match quite a lot with our philosophy. We also like to have between 15 or 20% in cyclic names. As the investment process is so long, we never know when the bottom is going to happen. What we do is we control a cyclic sector is buy some shares while the market is dropping, while the market is punishing them and the price is dropping. And then we have a 10% in commodities, always with a value approach. We normalize the price. For example, we have a mine of copper. We are normalizing the price of $3.5 per pound, which has been over 4 whole years. So we are very conservative with the assumptions. And this is one of the investment theses that shows perfectly what we do, and shows also that why we are not afraid of concentrating in a name when there is a high level of conviction. So Babcock, it is a defense business in the UK. They have 2 business lines. They do the maintenance for the nuclear submarines for the Royal Navy. There is not any other facility in UK, so basically they cannot change the provider of services. And they also do the maintenance of the nuclear energy, which is very sensitive, socially speaking. So the switching costs are huge. There is no incentive for changing the company. There is a huge interdependence between the UK government and the company and vice versa. And what the numbers are. The net profit normalized for 2026 is going to be of 360. We normally apply to a company a multiple of 15 times. If it is commodity related or cyclical business, between 10 and 12 times. And this one, as it is a high quality business, we're applying a multiple of 17 times, which is, if you take a look to the peers, the lowest one that the rest of the peers they have. So if we multiply this after a normalization, we do, of course, against the net profit, we're still seeing a upside potential of 130%. This company performed in 2023 at 40%. It increased its price at over 40%, and this year I think it is around 15%. And still it has all this value, and we've been invested into this company for over 6 years now. Okay. So the conclusions, the ideas I want you to keep about our company, it is like we have a great potential in our portfolio with a team and a process that has worked for over 30 years' time, with a deep knowledge in the companies, in the top companies. As I told you, we've been investing into them almost 6 years now. And above all, I think we have a portfolio valid for any market environment in terms of free cash flow protection. And that's it.
Peter.
Now, Peter, we will present his...
So you briefly explain 2 things.
One of the goals within the company, we use 15% of the income of the company to fund different initiatives in impact socially. One of the initiatives it is to help to foster independent investment managers. One of them is Peter. He's under our umbrella in Luxembourg, and he's focused on small caps, and he's been delivering very good returns. In fact, he was named by Citywire the best small cap fund in Spain. So he will explain he will talk about the fund now.
It's time you can stay here, Francisco.
Okay.
Because so Peter finally couldn't join by video, so that's why I asked to please start with an intro. With the floor, you can. I think summarizing it, so
I can do the presentation.
Okay. Very briefly, just 2 or 3 or 4 minutes, and then questions and answers for you and for Baja.
So basically, Peter Smith, he joined Cobas in 2017 with the promise from Francisco García Pérez of helping him to launch a new fund. So after everything, after a couple of years, we seed his fund in Luxembourg. As I told you, it is same principles, same philosophy we have, and they focused on small caps, mostly in Europe, which is where he had the chance of visiting and be close of this management. As you can see, the total returns have been quite good for the moment, and with still, it is a good moment, as our colleagues in VWM share with us. Small caps and value investing has been very, 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 very punished during the last years. So the chances, the polarization in the market created a huge opportunity on this side that eventually will reverse to the mean. But he's been able to return to give back value even in this situation. He started in 2019, so it's been a 5-year period of time, which is, I think, it is not bad. Well, here is Peter Smith. After, if you want to get in depth in the fund, I will be happy to answer that. But he follows the same principles we have, I don't know if we have an investment idea, but okay. They have, for example, this is one of the names he could invest. It is a small cap, which is a hotel value chain in Barbados. What happened? Basically, tax changes ended up into neutral improved for hotel industry. So there is no capacity to invest more in hotels. They have the hotel. They are the hotels they have. So it is not possible to get into this market. So they have kind of a competitive advantage in terms of that. It is not possible to create more business onto that. They received a takeover bid at 55 premium from Marriott. So it was a success opportunity. But this is the kind of things that they can take advantage of.
Do you have any questions for Francisco? About, yeah, one question.
It's really a very attractive enterprise companies, but as you mentioned, all is much better. Again, same question.
I cannot.
Could you say louder, please, Alex?
If you compare the performance of Babcock,
Yeah.
it's 5 years relative to Thales or Raytheon, who are also in defense, there's a huge difference. What is the main reason of the underperformance?
Well, when we invested in 2017, the problem was that some peers had committed fraud in their accounts. If you add to that Brexit, the company was so cheap. They had no trust from the market, and then the COVID appeared, and that created that some of the business were affected because they have a TIR with the submarine business of around 12%, but in the contract it's of 8%. So if they're able to cut costs and get better results, they go to this 12% easily, which is the main driver for our investment. And with COVID, that disappeared. So they had to divest in some of non-core businesses, as they had like high quality businesses, price that they sell were good, and they were in this process of normalization of the business. In fact, they've presented results today, and it is up to 7% in the day because the results are being very solid during the last quarters. As it is a very solid business, they don't share a lot of information. They present results a couple of times per year. So they're in this process of normalization. So from now on, I'd say that market is normalizing the price, but when they present results, they will go towards its target price.
Excellent.
See you.
Thank you, Francisco. Another question.
Yeah, just a quick one. It's very interesting. You said your investment process you collectively decide. So
Yeah.
What is the matrix that you use? How do you rank the ideas from everybody that come with an idea? And equally, how do you decide to sell?
How we decide? Yeah. So as I said, it is a portfolio management. So there is first an individual process. They have to come up with new ideas, and they have to analyze within a framework they share. It is not like each one of them has its own process. They have a framework to work with. This fast process, upside is good, quality is good. They develop the same framework, the whole model, and it depends the duration of this process. It could take. It depends on the sector. If we know very well the sector. It is kind of a democracy. Of course, at the end, it is an opinion. So, of course, I'd say that Francisco García Paredes in the investment committee opinion would weigh more than others' opinions. But at the end, they have to vote. It is true that there is a golden vote, but usually they don't. He doesn't use it because they have the same mindset. Same philosophy, I say. So they have disagreements, and that's what we need. Okay. Apart from that, we're long-term investors, but we're constantly making adjustments in the portfolio. So if a company today increases its price at 20%, we tend to reduce. And if another one drops, we sell some bips from one side and buy the other. It is true that we do not invest usually over 15% on one sector. So the companies while they are getting close to its target price, we start to divest gradually. When it is now, with the upside we have today, when it is around 50 to 60%, we sell the whole position. Yeah, but it is true that as of today, it is very, very difficult if in a binomial of quality and upside and conviction. It is difficult to find new ideas. So, for example, this year we only included around 4 names, and with a tiny weight. It is it is kind of a watch list. You know, we have 30 names, we have 55 portfolio companies, and top 20 are very concentrated, not very, but the rest, it is kind of a special watch list of companies we want to follow closely. It is not the same to analyze a company and only have the model that being invested in this company for 2-3 years. That's very important in our experience.
Thank you.
Thank you.
Now it's time for the coffee break, and we will be back in around 20 minutes. Good afternoon, everyone, again. Jean-Marc, the CEO at JMS Invest, is going to deliver the next presentation. JMS is a Swiss asset management company which has achieved outstanding results. Outstanding results. We were very impressed when we first read their presentations. They've managed to achieve equity, they've managed to outperform the European benchmark. They are experts in European equities, and they've managed to outperform with only 29% net exposure to European equities. So they have a long-short portfolio. They have also decades of experience in the market. They follow a fundamental approach with a bottom-up approach, and he will explain their approach, what they do, and what investors can expect. Thank you.
Thank you very much, Javier. I think I should hire you as a salesperson. You do the better job than I will do, probably. But I would like to thank Tenvalue for hosting this event, and I would like to thank you for your interest in JMS Invest. As you said, my name is Jean-Marc Müller. I'm the CEO of JMS, and I will walk you through the presentation. What can I say about JMS Invest? I think it was Larry Fink who said, asset management should be boring. Boring is good. And I think from an investor point of view, that is right. We should have steady returns, low volatility, no drama. However, for us working in the industry, I think it should be exactly the opposite. I think it should be fascinating, interesting, and exciting. And at least for us at JMS, I can say that we are super passionate about what we're doing. We are super passionate about our stocks, our portfolio, and all the opportunities and challenges that come our way. If you come and visit us, you will realize that the investment approach of the 4 portfolio managers is actually quite different. However, it is very complementary. And because of that, we managed to establish a very balanced portfolio. And then there's also ample expertise among the 4 of us. We started this 17 years ago, so shortly before the great financial crisis. Then we had Madoff, we had the flash crash, we had the Euro crisis, we had Fukushima, we had Corona, we had negative interest rates, we had inflation, we had a war in Europe. Everything the market threw at us, we mastered it. And obviously it goes without saying that as a shop here in Zurich, we are regulated by FINMA with all the necessary structures when it comes to risk and compliance. So what do? We manage a long-short equity fund, and I believe the secret sauce of our success is that we are very much focusing on a small niche. And the niche is the DACH region in Europe. This niche comprises of roughly 230 stocks, and it is our aim to know those 230 stocks better than anyone else. And how do we do that? It's through fundamental bottom-up approach. So we analyze those companies, we have our own models, we speak to the management teams of these companies, we speak to analysts, we benchmark our findings with consensus estimates and peers, we speak to friendly competitors. All this together should create a picture of a company better than anyone else has. And it is important to have this picture because when change happens within a company, we want to be the first one to realize. So we want to be quick to market and quick to execute. And it has served us quite well with an annualized return of roughly 7% per annum. I think we have shown that this approach works. And in that context, I shall also highlight the track record of 16 years. Now, the biggest advantage of a long track record is you don't have to justify your approach anymore, right? It works. Otherwise, we would not be in business. It's like a surgeon who has done a procedure a zillion times. You just trust him that he can do the procedure one more time. And that is similar for us. And the track record, and I will speak about the performance a bit later on, is actually quite good. However, the most important part of this slide, in my view, is that we should speak about the alignment of interest. All the 4 people that I introduced to you very briefly on the other slide, all the liquid assets that they have are invested in our funds. We quite literally eat our own cooking. We live and breathe basically what we do, and we are dependent on the performance of these funds, just as our investors are. I keep saying that your performance is our performance, and I believe that is how it should be. Now, quickly on the performance. The green line is Alpha Core 1, the fund we manage since a bit more than 16 years. And yeah, it looks quite boring. Boring is good. I think the goal must be that we limit the major drawdowns, and if we have drawdowns, that we can recover as quickly as possible. I should highlight that we have outperformed relevant benchmarks, such as the Eureka Hedge Europe Long Short, and also like a long only index, a benchmark index like the Stock 600. We have outperformed quite considerably. I should also note that these indices here, that they are in euros and dollars. Our performance is in Swiss francs. So if you were to actually FX adjust, the outperformance would be even more considerable. So how do we do that? The absolute performance in itself obviously doesn't say that much, right? You always have to see absolute performance in the context of the risk that you're taking. And this is actually one of my favorite slides because it shows that the performance we're achieving, we are not only outperforming benchmarks as we've seen on the other chart, we're also doing this with having much less volatility than actually peers or a long-only index. I mean, if you compare to the long-only index, the volatility, the risk profile of the fund is actually less than half of what a long-only index would suggest. And this then leads to very solid ratios, just as Sharpe and Sortino. And in all fairness, this is the reason why we keep winning awards, because those institutions that benchmark us with other funds, they look exactly at risk-adjusted returns as their main metrics number. One investor once told me, you know, these numbers kind of can compare like this. If this was like Volkswagen, let's say, when you buy Alpha Core, when you invest with Alpha Core, you get the Mercedes, but it actually uses half as much gasoline as a Polo would from Volkswagen. And I think this little anecdote kind of highlights quite well what we do. It is a very conservative product, but still produce quite solid, outstanding results. Now, why is the volatility so low? And I kindly, shortly describe this here. It is mainly coming from very low exposure levels. So the gross exposure is around 100%, and the net exposure is around 28 to 30%. I think since inception, it was around 28%. And these low exposure levels obviously lead to a quite a lower volatility of the product itself. Now you might wonder, but if the beta aspect of the fund is so low, why is performance so good? It's simply what we call alpha. I looked at the numbers since inception, and we managed to capture roughly 4% alpha per year on an annualized basis per year of alpha since inception. So out of this CAGR of nearly 7%, actually 4% is coming basically from our hard work, what I described, analyzing the companies, doing the legwork, the bread and butter business, trying to find hidden gems before everyone else does. This brings the 4% alpha, and on top of that, we have the beta component coming from a small net exposure of around 30%. That then comes on top. But obviously all this with very low volatility. Now, why do I believe that it is an interesting time now to look at a product like this? And I think the next chart is quite telling in that sense. This is the underperformance of small caps versus large caps in Europe. So you see that basically small caps have outperformed over time, and that makes sense because the risk profile of a small cap is much higher than of a large cap. Obviously the return profile also should be better. So we should see some outperformance of small caps versus large caps. However, there are always times when large caps underperform, small caps underperform, sorry. This is during the great financial crisis. We had a substantial underperformance, which was then recovered in the years to come. And then basically the small caps went back onto the trend rate that we had. Now, since roughly 3 years, we see a similar underperformance of small caps versus large caps. It has also, in terms of underperformance, quite similar to what we've seen here. And we believe that eventually there is a trend reversal trade here to happen. And if we were just to go back to the level where we were around summer of 2021, this would already imply an outperformance of small caps of around 30%. So, very simplified, if this was to happen over 5 years, we are talking about a tailwind of roughly 5-6% or so per annum, which then supports our strategy. So we would probably be able to even achieve better CAGR numbers than we have in the last couple of years because we get the tailwind from a potential small cap rally. Now, obviously, when this is exactly happening, we don't know, but we are very confident that it will happen, and we are excited for that opportunity because we then really want to fully capture on it. So, in summary, what have we done? So I think we have shown that we have a successful strategy, that we have been around for 16 years, which is not obvious. I mean, it's not so easy to find that many peers with such a track record. It's an award-winning track record. I think we have proven that the strategy works with a lot of downside protection. It's quite a boring strategy, but I believe that steady returns are to be favored compared to volatility. We have compounding returns in all market environments, and obviously, but I mean this goes without saying, I think we have a very good structure here in Zurich, being FINMA regulated, and the funds, they are based in Ireland, they are all under the UCITS structure regulated by the CBI. And again, I would like to highlight that we live from what you live. Our cooking is your cooking, my performance is your performance. I think it's very relevant to understand that. With that, I would like to close, and if there are questions, I will be more than happy to answer them.
Are there some questions? Yeah, I see some hands raised here first. Gustavo?
Yes, you talk about long-short pair trading basically. How do you assess? Do you have to go deep into those two companies you're gonna put against each other in pair trading, or are more I wouldn't say top down, but are more, what's the word for that?
It's actually we do not only do pair trading, right? So the long book really comprises of the stocks that we like, investment cases. We have researched for many years, companies we've known for many years, management teams we've known for many years. This is also not a very trading-oriented fund. If we like a story and the investment case works, we can stay invested actually for many years. The short book, which is the red line here, the short book comprises of three elements. One is outright shorts. So just things we don't like, right? Companies where we believe they will underperform the market, where we actually believe that regardless whether markets go up or down, we can actually achieve alpha just by being short that name. Then there is a component where we do kind of match longs with some shorts. It can be an individual short, but it can also be kind of a subsector. The easiest example is I like Elmos, which is a semiconductor company in the automotive industry. I am short the stock 600 automotive against this long trade. And the third one is, and this has more to do like with factor modeling, etc. The biggest risk we have as a fund is our exposure in small caps. And it's very difficult to short that factor, to limit that factor risk, because you cannot just short a basket of small stocks. You don't get the lending, etc. And to limit the risk there, we work together with Morgan Stanley, and they look at our portfolio and they actually put together a basket for us. And this basket consists of small cap stocks, and we basically only have to short the basket, so not all the individual stocks that are in the basket. Morgan Stanley then is doing that for us. And that limits our kind of factor risk small cap. And this has worked very well. I mean, in the past, we were short stocks Europe small, the smallest 200 stocks of the stock 600. But compared to what we are long, these are still kind of fairly large companies. And there was always a mismatch. And with the new basket now from Morgan, I mean new, but it's a couple of years now, this effect has worked much better.
John, Pascal, there are two more questions. If you can please reply in around a minute, just for
Sure. Short answers, yes.
And this one, Arthur, you can ask.
Hi.
Thank you.
You show sort of the average performance annualized over a large period of time.
Yeah.
How consistent has it been over the years in terms of how sort of uniformly distributed? In some cases, there are funds that perform quite well at the beginning when they're smaller.
Yeah.
And they, over time become more average, but annualized over the years, it looks good. How is this in your case?
I agree. I mean, this is now since inception, and it's fair to say that here, especially at the beginning, especially also the relative performance has been much better because we did very well, during the financial crisis. It's also fair to say that as a hedge fund product, with a lot of cash, basically, because we only net 28%, so we carry a lot of cash, that the phase with negative interest rates was not helping. And we already see quite now a difference here since interest rates have come back, that the outperformance, I mean, this delta of negative interest rates to positive interest rates is obviously helping overall performance. The alpha contribution actually can be quite wild, so I would not say that in the beginning alpha was much better than later on. And for example, this year we have a very good year with, I mean, in Swiss francs, we're up nearly 9%, and the alpha contribution is actually super solid because S stocks, M stocks, they're all negative, right? So the alpha contribution is very high.
Thank you. Thank you for the question too. The last question. Yeah.
If it's working so well, why only DACH?
So two quick answers to that. I mean, you know, why did we choose DACH? We chose DACH because we felt at the time typically quite a good sample of companies, you know, innovative companies. We felt that actually management teams quite good in general, right? Disclosure quite good, governance quite good. So we felt that altogether this is already a good sample of stocks to have. And then we also felt that there is a language advantage when you can, because we speak a lot with the analysts, the management teams, etc. So if you can speak in the home local language, I think that gives you an edge. And I think it works. However, we also feel that the approach is working in different markets. And this is why we have set up a second fund, which I did now not really present because it only has like 2.5 year track record now. It's called Time Horizon, and there we actually take a pan-European approach. So this is the idea that we can grow as an asset manager, can grow the assets even more because there are some capacity constraints when you deal in small caps, you know, liquidity, etc. is not good. So this cannot be much bigger than 200, 250 million maybe. And the other fund being pan-European and a bit broader in scale, we could then actually manage more assets. But thank you very much for your time.
The next speakers will be Sven and Gregor, CIO and CEO at SG Value. SG Value is a Swiss asset management company which stands out due to their strict investment policy. They follow a deep value investment approach. They've achieved extremely good results for the very long term. They joined forces in 2011, and the team together, they've been managing those strategies with the same approach for many years. It's very outstanding how also, because they have funds focused on global equities, including emerging markets, and also focused on Japan. And they've achieved double-digit returns for the very long term in Japan, which we believe is extraordinary. And also in terms of their global strategies and all those strategies, as we've spoken before, as we've discussed before, the last years it's been extremely tough for many years focused on deep value strategies. And having achieved those solid results with such a complicated environment makes us believe that as the environment is a bit more favorable for them, they will be amongst the best companies in terms of long-term performance too, and they will stand out and they will make their clients extremely happy. So thank you for joining Sven and Gregor, and they are going to explain what they do.
Thank you. Thank you very much. Thank you so much for the nice introduction. Thanks for the opportunity. Thanks for listening to us. And so I'm Gregor Traxel. I'm a part of SG Value Partners. Sven, the other part, sits there in the back. I prohibited him from speaking today because I'm speaking rather slowly, so I'm going to take up all the time. But he's used to that. Anyway, today we're a small shop, but we have 4 mutual funds under responsibility, 3 of which are global all-cap funds for different client constituencies. And the longest one is the Warburg Value Fund. We actually set it up, Sven and I, at Warburg at the time when we were working there in December of 2004. So in about a month or so, we're ready to pop the cork on that. So 20 years in that tough environment. We're quite proud of it. We didn't have any style drift whatsoever. For good or for bad, you can call us stubborn, but that's how we do things. And I'm trying a little bit to explain how we do it differently today. As you mentioned, Javier, we also manage a Japan-focused fund. That just came about because we found so many cheap stocks in Japan. We pounded the table with our boss, and at the time we were working at Credit Suisse. He gave us the opportunity to do it in 2010, so we came into the positive mood about Abenomics in Japan. We didn't really know about it. We just saw the cheap stuff that's lying out there. So that's how sort of the philosophy that's behind our approach. So value landscape, everybody has their different cooking, everybody does it differently. If you go into one extreme, you got to go distressed. You look at liquidation cases, you're trying to make a buck. You don't care about the quality of the business. You're just in for the workout and to make some money from that. For that, you know, you got legal know-how to do workouts. We don't have that. So that's one extreme. The other extreme is people who do GARP, growth at a reasonable price. They like excellent businesses, but they're just willing to pay a little bit more for an asset. And so we're trying to pick out, you know, the middle. It's kind of a Swiss thing. You're trying to go with what works. You look at other people, and then you sort of pick your niche over time. And we're actually we're buying companies that are merely, for us, going concerns. They are not outstandingly attractive on a first sight whatsoever. For us, they have to make strategic sense for the next 10 to 20 years, not more, not less, but we want to buy them at an extremely attractive price, and I'll go a little bit into that. So the charming thing about how we do it is not many things have to go right in our companies, and then you're already gonna be able to make some money, especially over a well-diversified portfolio. So deep value for me, it's all about expectations management. You know, first of all, maybe investment performance. How we think about investment performance. We want to buy cheap, and we think a company is worth more than what the price is actually at the moment. My problem is, I don't know when it's going to happen. Tomorrow, in a year, in 10 years. I quite frankly don't know. So I'm in the deferred gratification game. I save for my retirement. I'm in deferred gratification. So logically, we think about in performance in terms of absolute returns over time. If you must deliver instant gratification, as the world today is shaped about, then you're going into the relative return game, obviously. We can't play that. We don't want to play that. Our clients don't want that we play that, because sooner or later, you're going to buy the stuff that's in the index, or sooner or later, you're going to do what other investment managers do. So we want to stay free of that. Now, how we go about investment selection. Briefly said, we are going to companies that have one or more readily identifiable problems. Problems that are readily on the table. I can look at them, I can judge them, and then I'll relate it to what the stock price has done. What's the stock telling me about that problem? And then I make a judgment, is it already discounted in the price, or is the majority of the problem discounted in the price? And then I'm willing to give the company time to remedy the problem or the problems over, let's say, the next 3 to 7 years. That's how we go about it. And so You can pick all the attributes you want. We go to messy, complex, misunderstood, and ignored situations. Or Bruce Greenwald calls it cheap, ugly, ignored, and all that stuff. I mean, it's really bad. It's bad attributes. So we go where it hurts, and I think so few people want to do it that there's a price to actually to be worth to do it. So in terms of portfolio management, that's very important, and those who know me know that I'm adamant about this. At the end of the day, it's all about the statistical effect over a broad portfolio. In our case, we have stocks that go through the roof to the upside, and we have stocks that tank. And I cannot control what's going up this year and next year. I'm completely dispassionate about it. But if you do it diligently over a broad portfolio, I think if you buy on the cheap and you go through your mental model and do it over and over again, you buy cheap, you think it's worth more than actually the mistakes you may make. They're gonna rescue you. So we're not about deep dive in the companies. We never visit companies. We never talk to them. In fact, when they call us up, we say, no need to talk, just do your business. And so we want to have the distance to the business to have an objective view of what's going on in the company. We have to be rigid with ourselves, not with the company. The company should run their business, and I have to understand it enough to make a judgment. So I want to know enough about the business that we don't make too many mistakes. So we take a sort of a negative selection approach to the business. And that's where we're kind of close to Ben Graham. And I'm convinced today, if Ben Graham were an investor, he'd do a quantitative screen of the universe. And in fact, even though we're bottom-up fundamental investors, case by case, if there was a screen, if there was a formula, if there was an algorithm, I'd do it. And I think about it all the time, but so far we haven't been able to do it. Our portfolio manager is an engineer by training, and we're thinking about it all the time, but he says, so far you cannot capture the mental model that we have so far in a quantitative screen. But in a way, we'd be systematic investors, but as of today, we're not yet. So just, current performance dynamics, Javier mentioned it, we really have a tough time at the moment. If you're not in mega cap or at least large cap, if you're not into something, let's say, high tech, AI, social media related, and if you're not US or US dollar driven predominantly, you're going to have an enormously difficult time. But I think for the future, and that's the common sense in this room today, I guess, there's so much pent up value in forgotten, ignored stocks that I think the future will look extremely promising for all of us. So, as I mentioned, there's got to be identifiable problems that we look at. So there are pockets of value that come about over time. They've come about over the last 20 years, and surprisingly, they stay very, very stable. So we go all where it's ugly. If you look at regions, we have a bunch of stocks in Europe, France and Germany. I don't have to tell you at the moment. I mean, there's just total gridlock at the moment, both economically and politically as well. Japan, not exactly the go-to place for Western investors. Is sort of an enigma. I don't really understand how they think, even in corporate terms. They have strange management practices and so forth. So I'd rather stay away. So we've always find a lot of ideas in Japan. Emerging markets, it's been a low reward place, let's say, since the commodity super cycle. It's here or there you had some pockets of things that work out, but we're waiting for, the impetus for the next growth phase in economies. So there you have problems where we are regionally. Then we like to buy companies that are in the intermediary space where people don't see the end product. So they're just being regularly ignored because the people are not interested in they cannot feel it, they're not Peter Lynch style. I can go into or walk down Bahnhofstrasse and I recognize the product. So they're intermediary products there. We actually have an analytical advantage already. Then economic sensitivity very high. People don't want cyclical stocks. And the main part of our portfolio is cyclical. So there you have an advantage if you're coming in from a cheap enough perspective. Then people don't like mature businesses. They don't grow fast. So I want a business that grows. We have businesses that grow GDP a little bit, GDP plus, top line, not much more. So there opens up for people who are willing to look at it. Business focus broad. We love conglomerates. We love holding companies because they're hidden assets that people don't look at directly. For analysts, it's difficult to cover, especially on the sell side. So opening up opportunities there. Next, capital financing needs high. Most of our businesses, they're very capital intensive. In fact, they have a big challenge ever returning their cost of capital. It sounds strange, but we're always, challenged. We own utilities, we own telecommunications companies, we own heavy machinery companies. It's very difficult to make money in our business, but that's what people driving away from, and that's an opportunity for us to look at. Size, small, especially today, we don't have to say, people don't, if you can buy the S&P 500 and make a load of money every year, why bother with small caps? So we're in small caps. More than 3/4 of the portfolio are mid and small caps. The ownership structure, we love family companies. And they are, not attractive for activist investors because when they call up the company and say, change your management, they're going to laugh at them. It's not interesting for sell-side analysts to cover them on the brokerage side. So that, again, gives us opportunity. So this is systematically where we go and look. And we would like to define a screen if we could, but so far, again, we could not do it. And so I would defer this slide for a moment. Maybe I'll come back if I have a little more time in the end. Now, portfolio breakdown. This is our youngest fund, the Circle Fund. It's a global fund. You see how quirky and obscure, the stock picking and the overall positioning is. Industrials and materials already make up half the portfolio. So highly cyclical business case that you buy when you invest with us. Well, we're fine with it. Consumer staples is more niche place. It's not the Procter and Gamble's, the Nestle's of the world. It's smaller companies where people actually don't really look at. As I said, telecommunications is a big theme, especially in Europe. I think there's going to be more and more cross-border mergers among the big telecom carriers. There's no way around it. They're creaking. They're barely surviving. And everybody, you know, with social media and streaming and everything, they plug more and more services onto the telecommunications firms. They cannot expand their infrastructure because they're, you know, it's so capital intensive, and they should be able to do mergers in order to enable that capital flow. And I think the regulatory environment is going to go to the direction that you're actually going to be able to do cross-border deals in telecommunications carriers in Europe. So that's part of the deal. Anyway, if you look at the country setup, Italy, Japan, these days Germany is almost look like an emerging market, given you know what the state of the economy is there. So Brazil has always been a big part of the portfolio. And then, as I said, you know, market capitalization is huge tilt towards smaller companies. If you look at some of the stocks that we own, you might know Sulzer in Switzerland and Saint-Gobain, the large French building products, glass manufacturer, and otherwise it's really quite eclectic what kind of portfolio positions we have. And just to give you a sort of an overview of what we've been doing recently in order to give you a flavor about the kind of stocks we are looking at. Actually, the value realization side, on the sell side, 3 of those stocks are takeovers or potential takeovers. Benesse, they're running crime schools in Japan, and they also have a nursing business for the elderly, so they're playing the very young and the very old in that sense. It's gone through management buyout along with a private equity investor. We made some good pop-up when the stock was taken private. Same thing, Lawson. Some of you might know it's a convenience store business in Japan. It's gone private as well. Was bought away from us. International distribution, the nice owners of Royal Mail. It's actually trying to be bought by Daniel Kretinsky, the Czech investor. It's not through with the regulator in Britain yet, but they're trying to make a decision. We decided when the stock popped that we were going to sell it. ABB, you know, we owned it since it was below a franc way back. And now it's $50. You know, the story has been pretty much been playing out there. So, and Rolls-Royce is a classical example of a turnaround. You know, after the pandemic or in the middle of the pandemic, they barely survived. They had a huge multi-billion-dollar capital increase to take care of to save the business. And after that, when people decided to fly again, you know, the stock exploded. We were able to sell the company. The buys, you know, just I give you a flavor. You can look at it at your leisure. I'd say, in the interest of time, just one example. Palfinger we bought recently. It's a neat Austrian company. They have truck and ship-mounted cranes and hydraulic. You know, equipment especially for the construction industry and also for the marine system.
Could you also please name 2 companies, Japanese companies too? Because we cannot take questions from the audience because of time limitations, but if you can also.
Okay. Sorry, Javier. Yeah, I skipped this slide, so I'm going back to Japan. Japan has been a special story. It's come out of nowhere, and it had a huge run up after Abenomics. International investors came in. So I want to be clear about what's driving Japanese businesses. It's expansive monetary policy. We're not investing in Japan because of the expansive monetary policy. It's going to end. So the companies, they have to be able to survive and not play on cheap money. So an alternative to China it's for asset allocators. We're not interested in that. We're not in Japan because of that. So that's passing. Forget about that. Momentum-driven investing, indexing, although it's now consolidating a bit, it's of no interest to us. But what's staying is companies that are really cheap. I think still, most Japanese companies that we own in the portfolio, they're significantly below book value. Most businesses still don't get adequate returns on equity, but I think the structural changes that are being made by the policy makers on the one hand from a push side and from a company perspective, from a pull side, they're going to stay, and that's where we look at. And there's still plenty of opportunities in Japan that can be bought at very cheap prices. So we stay true to Japan, but you have to be there for the right reasons.
Gregor, what kind of returns, annualized returns, you think investors should expect from Japanese companies for the next 3-5 years?
Well, I cannot say about SoftBank and Nintendo and Sony and all these things because they're widely too expensive for us. And sort of the stocks that go into the AI narrative these days. So I have to take them out. Companies where we're investing, I think we're sort of shooting for 10% run rates of return. That's our aspiration. It's not huge, but given that we're only investing in okay businesses and not superb business, that's good enough. We're easily on that path. I'm not saying, because of my stock picking, I think the potential in Japan, even though we had this huge run up in companies there, is still being given. So you can earn double-digit rates of return over time in Japan. But it's definitely become much more selective. At one point in time for the Warburg Value Fund, it's a global fund. We owned close to 50%. When was that? In 2012?
2011.
2011. People say, are you people crazy? In a global fund, Japan is not working. And we have taken this all the way back to around 15% now. So we had a lot of value realizations. But still, the Japan fund has about 60 stocks. And they're screamingly cheap, the stocks that are in there.
Yes, extremely interesting. And also having seen so many different asset management companies in Europe, I think there are only 2 or 3 companies focused on deep value strategies on Japan. And you are one of the best ones in the Japanese market. So I think you have a very attractive niche for investors there, plus all your experience in global equities and your offering. So thank you so much for your time today.
Thanks for the opportunity.
Thank you. And the next presentation will be delivered by Rolf. He is the co-founder at Carnot Capital and investment director. He works as fund manager at Carnot Capital. We also first realized how good their performance, long-term performance has been many years ago. They've managed to outperform the main European benchmark since inception. So Rolf has been awarded our AAA rating. They started in 2007. It's an impact asset management company, impact investment asset management company, and they are very focused on also sustainability. So they want all their companies to be very good socially. He explained that perfectly. So they not only want very good long-term financial returns, but also they want their companies to have a positive impact on society. I believe that both things are as important for them, and he'll explain everything. And congrats on the great results, and also thank you for coming here today, Rolf.
Thank you, Javier. Thank you for having us. We're a bit a strange animal here today. As Javi already mentioned, we do like quality growth and we do like sustainability. I'm going to show in a second why we like it and why we think it's a source of alpha and we make returns on this. So we started in 2007, Javier mentioned. We run two theme funds, one on energy, one on resources. So it's a bit similar drivers. One is European, one is global. And they have similar drivers, and that's electrification, digitalization, and sustainability. Electrification, so theme funds, of course, as a value investors, you probably don't like theme funds too much, but we think these are long-term themes. So we started 17 years ago. They were top of mind 17 years ago. They are today, even more today, even more after the war in Ukraine. And they're going to be in 15 or 20 or 30 years, probably even, it's going to be a top priority of the world to produce enough energy and to produce enough resources. Electrification, of course, in the car, we have this drive for electrification. Maybe we have a slowdown this year. Not in China, though. In China, every second car that is sold is an electric car. Europe penetration is 20%, slightly lower this year compared to last year. In the US, we're low double digit. We have electrification in the buildings, smart homes. A lot of copper is built into houses today, much more than it was 10 or 20 years ago, and it will be more in 20 years. In the industrial world, in Internet of Things as a topic. And one driver of this electrification, of course, also is digitalization. We heard AI already as a topic earlier. It is a topic, it is going to happen. Maybe we're not making a lot of money as investors in AI, but it's driving the need for electricity. Alex and I, we were at the same presentation earlier this week, and AI is driving the use of energy. Just a story on the side. 10 years ago, data centers were built somewhere in the north where it's cold. These days, data centers are built in the desert because the desert has cheap available energy, photovoltaic. So the world is changing and digitalization is driving the need for energy. Sustainability is a controversial topic. We think that it is a mega trend. Maybe it will be a bit slower the next 4 years, of course, with the election outcome in the US. But the topic is driven by people. People want more quality in life. And of course, this is a luxury good. It's more important when you already have a car or you already have a house. That's more important. But also in emerging markets, we see this trend, and specifically also in China. And now, of course, in the US, on the government, on the nation level, it will be not as important going forward. On the state level, at least along the coast, it will remain a topic. But the good thing maybe of the new government is a lot of money was wasted or is wasted in plans that are subsidized by governments. And maybe that's the opportunity of the new government, that money is invested in a better way, in a more economic way, with a better return. But the trend, we think, is going here to stay. So Carnot Capital, we're a small asset manager, 250 million, two main funds. Thank you. We are a theme investment manager. We have a quality growth style. This is the team. Andres and myself, we founded the company in 2007. Andres is doing our back office, everything from regulation and so on. Lucas is a young portfolio manager, so with 3 investment professionals. Janina, we newly hired for marketing, and then Nico is a young assistant that supports us on the portfolio management and then the board. I picked the energy fund to introduce quickly. So our topic, or the name of the fund, is Carnot Efficient Energy, or it could also be energy transition. And energy, You can save energy, of course, where the energy is used. So it's in the building, that's number one, in the industrial process, and in transport. So these are our three main sectors. And then as a bracket over all these sectors is IT software. Because everything, when you want to save energy, you need to first measure. So you need sensors, silicon. You produce a lot of data. You need to do something smart with this data, so software, or today you call it artificial intelligence. And then hopefully you find a good way to reduce energy consumption. And then you again need some device to change something in the process. And in many cases, again, that's a chip or silicon. So these are the four sectors. Transport has been the tough sector this year. The auto industry is struggling in most places. Tesla is probably the exception there, but the European industry is fighting for survival. Also, some big names will not be here anymore in 10 years, so there's going to be change there. And luckily, we reduced the allocation from over 20 to over 10%, but it was, of course, a bad sector. We have 50% mid caps, 25 small, 25 big, and we heard the story. Small mid caps had struggled a bit, but we share, of course, the valuation thought that we're getting closer to a low point in valuations for small mid caps. Two examples, and I start with the one that is at least reasonably valued, 25 times. You're going to fall off the floor with the next chart. Schneider is an industry leader, 150 billion market cap, and they represent all the topics or the mega trends I mentioned before. They're making the grid more efficient. They're making data centers more efficient. This is the biggest topic in data centers, apart from the speed of the chips, is the use of energy. And it's got a nice chart. It's trading at 29 times earnings. It used to be, it was, or it still is one of the top positions in the portfolio, but with the fairly high valuation by now, we're reducing the position. Great company, and they're doing a lot for sustainability, and sustainability is partially driving the business model of Schneider. Clients of Schneider want to reduce their footprint, either because they have to, regulatory reasons, or because they want to reduce the cost position. And you reduce the cost position by reducing the use of the consumption of energy, and Schneider sells the tools to reduce energy consumption. Second example, a bit better known in Switzerland, and now be careful, it's got a PE of 50 times. Belimo. We started in 2007. We've been invested in the company since 2007. It's a great company. It started off as a small cap, and now it's got a market cap of 6 billion. We're reducing the position as well. It was fairly valued when we started. It was expensive for the last 15 years or last 12 years. And our experience over time was we made more money with the expensive companies than with the cheap companies, but maybe we should focus more on the expensive though. Belimo is a small, or is a Swiss company, started in '85 in Zurich Oberland, and the founders are still present on board level, but they're getting out of the business. It's a healthy company. It's 1 billion turnover. They're approaching a billion turnover, and the CEO makes 1 million or 1.5 million. So it's got a healthy culture as well, and that fits very well into our story. Belimo does little devices. They're a global player. They compete against Siemens or Johnson Controls with in their niche, but they control a market share of 40%. They're number one in their niche. They spend most on R&D compared to their competitors. It's a good example of what we're doing. I'm not making a stock pitch here for Belimo, but just to show you why we think these global mega trends I mentioned before, including sustainability, are a good base for returns and are a source of alpha. Why invest in Carnot Capital? We're founder-led. We're doing this for close to 20 years. Impact, our sustainability approach is not ESG. we think we go one step further. We do impact, and impact meaning the products and technologies of our investment companies. They do have an impact on the world, and this impact is reducing consumption of energy and resource, and this impact is one base of the business model, and that's why these companies provide higher growth rates and deserve higher valuations. That's it. Thanks for your attendance. Thanks, Javi, for having the opportunity.
Thank you. I'm sure there may be some questions from the audience. Do you have any questions? Any of you? Yeah, there's one question.
Yeah, I have one in relation to your impact approach. I mean, what's your theory of change? How does adding capital to your fund create additional change, I guess, in the real world?
I guess we're producing a double bottom line, financial return and social return. And our goal is to produce financial return. And we're not changing the world, but for us, sustainability is a source of alpha. We produce extra return. And on the side, you do something good. But the main argument is you want to have, as an investor, you want to have a decent return. We have one investor that I believe that he's happy with 1% less. That's Alternative Bank Schweiz. And for every other investor, they tell you, yeah, it's okay to make a bit less, but 1st of January, when you do performance review, they have forgotten what they told you a year ago. So it's about financial return. Thank you.
Questions? For the next presentation, Patricia Berjón, the head of corporate development at Global Dominion, will join via video call. Global Dominion, from our point of view, is one of the most undervalued companies in Europe. We believe that the investment case at the moment is extremely interesting. It is a good company with a very low price and a very good management team. Why is the company so undervalued? We believe that there are two main reasons why the company is undervalued. First, most analysts in the market are perceiving that company as very complex, and I will briefly explain why we believe that the company is a lot simpler than most people believe in the market. And then, if you look at their balance sheet, their consolidated annual accounts, you will see, for instance, at the end of the first half, you see there close to 200 million euros in financial debt, but most of that debt is not linked to the main projects and services division, which is the main business, and then they have some assets in ownership. So that out of 198 million euros in financial debt, close to 125 million euros is linked to the assets in ownership. Regarding the simplicity of the business, Global Dominion has two main core businesses. First, services. So it's sustainable, what they call sustainable services. In terms of sustainable services, it's mostly recurring revenues, so maintenance and maintenance services for different companies. So they get very recurring revenues, is extremely high cash generative. And then, so those, interestingly, so all those projects, they are very similar in nature, so they may have hundreds of projects, but all of them have a margin, a contribution margin of around 12%. And then they have their projects division, they call it 360 projects. All those projects are one-off projects, multi-year projects, and they are also very similar in nature. So they are one-off contracts, and for instance, the engineering and constructions of some like social infrastructure, like hospitals, then some plants, like industrial plants, energy plants, and here the margins are a bit higher, around 15% contribution margins. And interestingly, so with this business, projects and services, we expect an operating profit of around 100 million euros in 2-3 years, the company is worth 400 million euros. In this same, and most of the debt is linked to the assets in ownership. In terms of the assets in ownership, they've announced that they are not going to keep majority stakes in those projects. They're just going to take minority stakes. So as they sell many projects to new investors, they will get cash in, and that debt on the balance sheet will be out of the balance sheet. So we have a company able to generate around 100 million euros with organic growth. The projects and services division has grown organically at a rate of 9% per year for the last 10 years or so, with stable and growing margins. It's not a construction company, so we see that company more in line or more related, it's more similar to other companies in the market like SIA in France, or SPI, for instance, also in the Nordic countries, companies like Bravida, Instalco. So in local markets, the biggest companies, they've been able to maintain higher margins than their local competitors. And Global Dominion is one of the few companies which is global. So Global Dominion is present in 35 countries, and we believe that it will continue growing organically in all those countries that the company is present in. So a company generating 100 million euros, worth 400 million euros with pretty much no debt, growing organically very fast, increasing margins, and they also have stakes in businesses which the accounting book value of the stakes in infrastructures is around 100 million euros, and we believe that's worth more than 150, maybe even closer to 200. So enterprise value EBIT of 4 times or less. We think that the market is not valuing that company properly. It's very good, and also the management team, they're very strong. So they're the main owners are the same main owners of SIA Automotive, which is one of the best companies in Spain. Gestamp, which is also one of the best managed companies. So it's the Libertas family. We believe they are very smart businessmen in Spain. So we have good company, good management team, and a price that we believe it's very surprising. And Patricia, I very briefly explained the different divisions, and Patricia will explain the outlook for this division. It will take around a minute, as she's going to join us online, and you'll see her shortly. Hi, Patricia.
Hello, Javier. How are you?
Very good. I'm well, thank you. We can all see you and listen to you properly. So,
Perfect.
I already introduced very briefly the business. So I explained that you have 2 main business segments: the 360 project service, the sustainable service division, and then you also have separately stakes in infrastructure, which you intend to keep as minority stakes and not taking majority. So I think it would be great if you can please briefly explain the outlook for all the investment divisions, and you can share anything you want to with the investment community.
Okay, so I would like to share my screen. Let me know if you can see it. Wait a second. I hope you can see it now.
It's working now, yeah. Good.
Okay, let me. Okay, so first of all, thank you very much for to Tenvalue for hosting us, and it's a pleasure to present Dominion's story to you. As Javier has said, he's probably already give you a big picture of who we are and what we do, but I would like to focus more on our strategic plan and where we are going. First of all, we identified 3 main transitions that our clients are facing, and we are positioned and we want to be facilitators and partners of our clients to address the challenges that those transitions pose to them. So those, they imply many things related to decarbonization, circular economy, energy efficiency, electrification of the economy, and those kind of activities that are the activities that we are strategically positioned will drive our growth, and most importantly will drive an improvement of our margins. And this is something that we are already seeing in our numbers, because the strategic plan I'm talking about is a strategic plan that goes from 2023 to 2026. So we are in the second years of this plan. So we want to do this for our clients, and we will do it, or we are doing it, through our 2 core segments or main segments of business, which are the sustainable services and the 360 degrees projects. One of the pillars of the strategic plan was this positioning on sustainability, and the second pillar would be the simplification of the company. We are a very diversified company, but we want to reorganize or refocus our structure to address this challenge of sustainability. And we want to be clear that we are a company of projects and services, that we have those stakes in infrastructures, but it's a facilitator or a tool to maximize the profitability of the core businesses. So what you can expect to see during this strategic plan is how we are more and more focused on these projects and services that I'm mentioning. I'm sure Javier has gone through it, but I would like to highlight some things about each of these segments. Sustainable services, it's a segment where we are seeing a high organic growth. It's a segment very recurrent, and we have like a recurrency rate of 85% of the activities. And it's also a segment where we are seeing and we will see improvements in the margins. A lot because of this focused on high value added activities, and also because here you have, I mean, if you are following us, our story, or you start to follow it now, we have already made some divestments of activities that are less profitable, and we are focusing on the ones that are more profitable. So we could expect from this segment that it grows strong organically, but also M&A will come into this segment, some reorganization in form of divestments. It's also a net cash business because it's the 2 main business segments, both services and projects, are net cash or high levels of cash flow generation. 360 degrees projects is not so much about recurrency, it's more based on backlog. So we have a backlog of more than 2 years, a backlog above 600 million euros. It's a backlog that gives us visibility on the top line, but also we know that the margins in this segment are high nowadays and will be high because of the things that we have already included in our backlog. This segment will mainly grow organically. We are not planning so much M&A or new investments in this area. We have prospects for it in all of the areas, the social infrastructures, industrial infrastructures, and also the energy ones. Even if it's a project kind of business, it doesn't require CapEx, and we're seeing very good opportunities here. And last but not least, we have these stakes in infrastructures, as I said, that this wouldn't be a segment in the same sense as the other two ones, but more a way of maximizing the other two. I think the most important thing in the near future for infrastructures will come in the form of divestments of the infrastructures, the assets that we have here. We have some debt linked to those assets, and I think those divestments that are close to happen could become catalyst of the story and of the stock. As I know I don't have much time, I wanted to go a little bit through the strategic plan and now highlight some of the key elements that I believe are important in Dominion's equity story. The first two of them very related to this positioning in growing trends. Also with this unique value proposition of covering the whole value chain and capturing the maximum of the margins of the value chain, positioning us as a high or as a value-added partner for the clients. Also, this strategic focus on sustainability is not only as an opportunity, a business opportunity, but also it's a commitment to be a sustainable company, and we have our targets of ESG and we work towards them. I would like also to highlight that we have a strong management team that has been in the company for a long time. Our CEO being also founder and shareholder with more than with almost 6%, with our top 50 directors with the skin in the game as shareholders as well. And also this team leading a company with a very strong culture. And for us, this is something very important because we are a company made out of people. So this would be the 5 key elements of our culture. Digitalization, because we really believe and we really apply technology in everything that we do. Diversification, with more than 1,000 clients in 35 countries, so non-dependent on any of those clients or the different sectors we are present at. Decentralized management model, which incentivizes very much the different management teams, and we incentivize them based on their cash flow generation. And this leads me to the next one, this financial discipline, very focused on cash flow generation and looking at the lower levels of the P&L, and sustainable development, as I mentioned, both as an opportunity, as a responsibility of a commitment as a company. Apart from this, I would like to highlight the track record of the company. It's a company with a high cash flow generation that we have generated since we are a listed company. Story of profitable growth. We have both growth our revenues and our margins at high levels, and it's a mix of organic and inorganic growth, but we pay a lot of attention to organic growth. And it's not that we are staying where we are. We have moved our EBITDA, for example, in the last 8 years since our IPO. We have tripled it from 50 million euros to 150 million euros, but we have ambitious goals for the future. In our current strategic plan, those are the targets for the guidance. Once we have met the 2023 guidance, the guidance for the first year, now we are in this 2024-2026 guidance, where we talk about CAGR at the levels of sales more than 5%, that will translate into an EBITDA growth of 7%, and then an operational cash flow generation of 9%. All of these paying attention to the return on net assets that it's been, and we are targeting it to be higher than 20%. And we want to move back towards a net zero debt. We have always been a company in a net cash position for the last couple of years, due to this transformation of the company, or this bet for to owning or have some equity in infrastructures to build those core businesses and to maximize them, we have in a transitional period or something temporary that we have this financial net debt, which is very important and is linked to assets. We have it in place, but the plan is that by the end of the plan, this is reduced to a net cash position or net debt zero. And this is what I want to share with you.
No, very good. Anything else that key important? There's limited time, but maybe if there's something else that you wanted to highlight.
No,
we can go for
what
questions.
I wanted to try to meet the time constraints that we have.
Yeah, very good. It's also important because in Spain, when we speak to many professional investors, and Global Dominion is a very well-known company, so you can see that name in the portfolios of some of the best independent asset management companies in Spain, but outside Spain, not many people know about the investment case, so it's a bit about complexity, the perception of complexity that we strongly believe that is very simple, it's a lot more simple, it's a lot simpler than what many analysts believe, and also we think it's just a matter of time that many people don't understand and don't know about the activities and about the investment case. Do you have any questions about Global Dominion? There are no questions. Yeah, there is one question.
I would have a question. If they're looking at the project, how it's structured? I mean, 35 different countries, quite complex. What is the formula? I mean, do they then do and sign it? So I get the project finished, turnkey based, and the risk is at Dominion, or how do they structure it? With the costs of implementing it, building it, etc., etc.
Patricia, I don't know if you listened. If you could listen, I would also add that.
I couldn't get it very well, but it was related to the risk of the project.
Yes, because you are present in more than 35 countries. So how are those projects structured? If they're like turnkey projects, like the length of the projects, and if you can also link that, because we're aware that you have even higher margins than the main companies in the sector, even the best ones. So first, how are the projects mostly structured, and then why are your margins so good, or why they've been so good historically?
Yeah, they are turnkey projects. We want to be present in as much in the whole value chain, because we want to capture all the margin, and being present in the design phase and then executing the project, and even staying in the long run, providing the service of operation and maintenance of this infrastructure process is what we want to do. That's why we have higher margins than maybe other competitors, because we are capturing the whole of it with very relation of partnership with the client. So it's usually win-win. We have a wide variety of kind of projects. So in terms of volume, they can go from little ones of 1 million to the biggest ones that could go higher than 50 million euros. Even some specific ones, not in parallel, but at some points of 100 million euros, for example. It's very, very important to us to manage the risk. It's where we pay a lot of attention in defining the contracts, in defining the responsibilities and the guarantees that we have in those projects. In terms of length, that I think you mentioned it also, they differ. They could go from 3-6 months to a couple of years. And one other feature of those contracts is that they work with prepayments, and as they work with milestones, we try and we manage to maintain those prepayments almost in the end of the project. So I don't know if I'm answering the question or there was something else.
Yeah, are there any more questions?
Does it work on cost plus, or?
Does it work on cost plus, or?
Not usually. When we started doing renewables, for example, we started with open books because it was a kind of business that we didn't know very, very much at that time. But they are usually turnkey projects where we have a defined price and defined scope and timeline, and then we maximize the margin during the execution. But it's usually, we have a very, very good track record in executing projects, and that's the reason we can maintain levels of 18, 19, even 20% in the contribution margin of projects.
Thank you, Patricia. Thank you for joining us today, and we stay in touch. And
yeah. Thank you very much. I'm really sorry that I cannot be in person with you, but I hope that next time. Thank you, Javier, and thank you, Tenvalue.
In our next presentation, the investment director, the head of investments at a company called Libertas 7, is also a listed company, will join via video call. From our point of view, that company is worth between 4 and 5 times, excluding debt, what the price reflects. We haven't seen, there may be 1 or 2 more cases in Europe, but we haven't seen them. So, and it's it's easy to calculate the value of the assets. What they have is what's there on the balance sheets, and it's very simple to come up with valuations. Basically, Libertas 7 is a holding. They have 3 different investment divisions, and we see a very good management team, very good allocation policy. So good business, good management team, and very low price. As we said, that's what we look for. We only work with value creators, and we only work with companies that we like, whose price is very low. So this is also an excellent example, as Global Dominion is an excellent example, and ENCE is another excellent example. We also see clear levers. Why is the price so low? So we see clear levers because, well, historically, that's a company that not many people, most people until last year in the professional market didn't know anything about a company. It's a small company with low liquidity, but they are improving, and they are communicating extremely well now, and we are sure that over time liquidity will go to the market and to their shares. It can be seen that they've changed the website. They are doing our webinars with investors and so on. So that's part of the story that people didn't know about the investment case, and we like that. That's what we are here to simplify the information of companies and to speak about very good companies. So that sounded good to us. And then also, there are levers because the business is growing organically in the 3 different divisions. So it's not just how much other investors are willing to pay for a company. That's not as important. What's important is that the company can generate lots of cash flows, and the company is generating a lot of cash flows in all their different divisions. And we believe that the future dividends will be extremely attractive for investors, so that investors can just wait and receive dividends regardless of the share price. Basically, to make it very simple, so Libertas 7 has 3 different divisions. The first one is a real estate division. They have a home development business. Here, last year they built 33 houses, and they plan to build more than 100 homes by 2028. There's a shortage in the market. If you are familiar with the Spanish market, there's a shortage in supply. There are not enough houses being built. We hope a lot more supply goes to the market because this is a social problem. And even we see house development companies as social companies now because more homes are needed in the market. So Libertas 7 is a house developer, and that business will perform very well. In the past, why the historical numbers in their accounts don't look good? Because they were using land bought in the past at high prices. So they were showing the profits were not very high, but now with the land they are currently using and with good business prospects, we are estimating operating profits of around 15%. We've seen that the average in the sector is around 15, 20%, so we prefer to be conservative. So 15% operating profit margin with more than 100 homes built. They even built 300 in the past, so we think they will be able to reach those numbers. And with a price to earnings multiple of 10 times, that's more than 20 million, so 20 million euros in valuation. Then they have properties in Spain. They have buildings, offices in the center of Valencia for more than 15 million euros. So I said 25 times plus 15, that's one business division. They have two more. So they also have a tourism division. In the tourism division, they own 3 buildings in Valencia, in the Porça Playa area, a very good area in Valencia. And the buildings have been valued independently for a value of more than 20 million euros. In addition to the buildings, so they are also managing those buildings because they are in the tourism division. They operate the assets and they have apartments. And they manage those apartments to attract people to the apartment. If we assume that the business were run without the property, so if they had to pay for the rents, with the capacity, so at the moment they are at around 50-55% occupancy rates, but that's because some of the buildings have been closed for a year in reparation. So with 65-70% in occupancy rate, which is where they expect like the normalized occupancy rate, they will also generate profits with that division. So we think value should also be assigned not just to the buildings but also to the business, and we see more than 30 million euros in value. So we also have more than 30 million euros in value according to our estimates in this second division, and we also have more than around 60 million euros in financial assets, because the other business division is a financial division. They have around 50 million euros in liquid assets. We know some of those companies very well because we've researched some of them. So companies like Vidrala, Viscofan, we believe they are some of the best companies in Europe. Louis Vuitton and some others with a long-term view. Jorge will present today. He'll deliver a presentation, and he has a very solid academic background, and the way he invests for the long term. Selling a bit if the companies go up by a lot, buying a bit more if the company will, simple, long-term, common investing. So 50 million euros in liquid assets and 10 million euros in private equity. They expect to double their investment for the short term, and even more interestingly, they are about to get a lot of cash from those businesses because those investments were made some years ago and they are just getting the rewards. Very simply, we get a value between 123 million euros by 228 if we assume 5% per year annualized returns for the financial portfolio and 3% returns per year of revaluation of assets of the buildings or properties. We think that's very conservative because of the market situation. If we assume 10% return, annualized returns, which is more in line with what we think of the financial portfolio, and 5% per year of the assets, we will get 143 million euros. That's excluding debt. And the company is worth 30, according to the market. So, as we said, we also know the management team very well. We've been speaking to all the managers of the different investment divisions in person. We liked all of them. We believe they have a very good team of people, all of them led by Agnès Noguera. So the family owns around 80% of the shares. And if some investors want to invest in the company, they can speak to them directly, because even if there's low liquidity, some companies it's impossible to invest if there's low liquidity, but they wouldn't sell a huge stake. We know they wouldn't sell a lot because they know that the company is very undervalued, but they're open to speaking with investors just so that more entities join and there's more liquidity, and just for the benefit of the company for the long term, and they are committed to the stock market, and we're sure this is just a matter of time. We don't know if it will take 1 year, 3 or 5, but when we see a good management team, a good company, and no conflicts of interest, if the assets are worth a lot more than what the price reflects, the investment will always be good. So 100% sure of that. We just don't know how long it will take, and we're happy to work with Libertas and Jorge will join now the call, and he will briefly explain the outlook for each division. It will also take a minute or so to see them. Almost. Thank you for joining us. Can you see me?
Hello? Yes.
Yeah, we can hear you all perfect.
Can you
already
see me? Can you hear me?
introduced. Yeah, we can hear you perfectly. So I already very briefly explained the main investment cases. Sorry, the main business segments. And I said to them that you are going to explain and share the outlook for each investment division and the way you see things internally. Thank you, and you can now speak.
Okay, thank you so much, Javier, for your introduction. Let me try to share my screen so that you can see the presentation. Just give me a second.
Yeah. No hurry, as I also have it here, but we...
Do you have it there?
Yeah, but try it first, as there's no hurry, but...
Oh, yes. I think you should be able to see it now, okay?
Yeah, that's working now. Thank you.
Okay. Thanks, Javier, so much. Well, I'll try to be brief because I was asked to be brief with this presentation. Basically, just as Javier explained to you, Libertas 7 is a business group founded 78 years ago, which runs 3 distinct areas of activity since its inception: real estate development business, tourism business, and the financial investments area. In summary, Libertas 7 is a family-owned company, professionally managed by specialized teams in each of its businesses. And it's a company that has been publicly traded since 1980 and moved to the main Spanish market, Mercado Continuo, in 2021. Our value proposition consists of having 3 activities within a single company. In our vision, these businesses complement each other in terms of exposure to economic cycle, degree of liquidity, and some of them being more specialized and local, and others being more diversified, global, and capable of generating cash recurrently. Briefly, in terms of the company metrics, the main figures at the end of the 2023 fiscal year were as follows: revenue of 13.4 million euros, increasing by 16% compared to the previous year, an EBITDA of 3.1 million euros with a margin of 23% on sales, increasing by 46%, and a net profit of 2.3 million euros, which was 54% more than in year 2022. Our financial debt was 30.5 million euros with a net debt to assets ratio of 21%. However, if we consider the stock portfolio, which is fully liquid, we actually have positive net cash. So starting with the real estate area, we are one of the most recognized developers in our region, with decades of history, having delivered thousands of homes in many projects. In this region, local demand is at its peak, while supply is at its minimum, and the scarcity of available land and the growing need for housing have led to prices increasing recurrently over the last few years, creating a very favorable market conditions for this business in the long term. Having completed the construction and development phase of several projects, we are now entering a virtuous cycle, meaning that we will be delivering 2 or 3 developments or projects per year. And considering all the projects that we have in progress, we already have guaranteed deliveries for the next 4 years until 2028. Last year, we also launched a new business line focused on third-party commercialization, which is starting to generate revenue already. In summary, our goal in the real estate area is to grow in both volume and profitability. Just to mention that in the previous cycle, we delivered about 300 homes per year. So our team has the capacity to manage many more units than we deliver at the moment, while maintaining our specialization in the region. We believe that our knowledge of the business and the local market dynamics will allow us to take advantage of the favorable outlook for this business in the coming years. Regarding the tourism sector, the tailwinds for the city of Valencia are evident. Various indicators show that Valencia is leading the national growth in tourism revenue. The strong commitment of local authorities to boost tourism activity has transformed the city, resulting in a spectacular increase in tourists in recent years. We ran 2 tourist assets. On one hand, we own and run 3 buildings with 76 apartments in Porta Playa, which is a marina located 4 kilometers north of Valencia. And on the other hand, we also run a 4-star hotel with 42 rooms in the Old Valencia port in the Real Marina. We believe that our margins for improvement are significant in this division, and our goal in the tourism sector is to achieve occupancy and average price ratios comparable to those of the city of Valencia itself, and we are also looking for additional hotels and units to manage. Third, the activity of Libertas SIA Investments area focuses on taking stakes in both listed and unlisted companies or non-listed companies. Our goal is to enlarge the portfolio, increase the volume of resources invested, and ensure the growth of the portfolio for the coming years, based on the current management team's track record for over 17 years, during which we have consistently outperformed both our benchmark and the main indices of the Spanish and European stock markets. Our investment philosophy is based on achieving long-term profitability with a focus and bias toward value investing on a well-diversified portfolio in both listed and non-listed companies, as well as across business sectors and geography. We typically invest in Spanish or European companies that we can get to know and analyze in depth, but which also have global exposure. The portfolio's analysis, monitoring, and management are handled by our own management team with support from our own team of analysts, highly experienced and deeply familiar with the companies in the portfolio. This basically provides us with an agile decision-making capacity and, above all, total independence in the management of our investments. On the private equity side, I would like to highlight that over the past 6, 7, 8 years, we have made a significant investment effort, and these investments have now reached a significant level of maturity, and we expect them to generate cash flow results and profitability in the coming years. In addition to being a source of cash flow and profitability in itself, the investment portfolio provides us with a diversification tool for the group's other activities. We invest in businesses that are completely uncorrelated with the other 2 areas in terms of business, cyclical position, and geographical location. So history has shown us that the portfolio has helped generate a recurring cash flow compensating for weaker activity during low phase cycle periods of the other operational areas. Finally, why investing in Libertas 7? Well, we believe that we have laid the foundation for the 3 business lines for the coming years. We have great visibility across all our activities to achieve our goals, and certainly we have the commitment for that. Investing in Libertas 7 means investing in a group which holds a leadership position, has been managed prudently over 75 years, and where there is a total alignment between shareholder interests and corporate management. We also believe that our company has largely gone unnoticed by much of the investor community, yet it represents a great opportunity due to the expected evolution of the business and the valuation of the shares, which are currently trading at a significant discount to their intrinsic value. In recent years, we have been able to generate a significant volume of resources and cash flow, which we have primarily reinvested in our own business, as all 3 business lines are growing and are profitable with very favorable prospects. Secondly, we have made a significant reduction in the group's leverage, reducing debt. And thirdly, we have increased the shareholders' dividend by more than 30% in the last 2 years. And that is a policy that we aim to continue strengthening as one of the key points we are considering in the new strategic plan we are working on. Finally, as for the latest results we published 2 weeks ago, for the third quarter of 2024, the results were in line with our expectations. In the first 9 months of 2024, we achieved a total revenue of 5 million euros in the tourism and investment areas alone, which represents an increase of 19% over last year. And the company's EBITDA reached 2 million euros, and the net profit was 500,000 euros. And that's it from my side, Javier.
Thank you, Jorge. Yeah, we appreciate that, your explanation. You've done it very well. And I'm quickly going to ask them if they have any questions for Jorge. Yeah, there's one question here. So Arthur.
Why are they listed?
He's asking why you are listed. It's a company that is a. Why is Libertas 7? Why is Libertas 7 listed? Yeah, we've also heard that question many times. That's why I laughed, and you will explain that very well. Yeah.
Thanks very much. Well, that's a decision that was taken many years ago, and the idea was basically allowing for any shareholder to enter or exit the company very easily, since it's a listed company. And it also has provided us with the discipline to comply with all the requirements of a listed company. And that has provided us with all the internal mechanisms in order to report and manage the company accordingly. So we believe that this is something that may add some additional costs, obviously, for any listed company, but it is also a way of allowing other investors to enter the company and exit easily. And we believe that there are more pros than cons in this case.
Thank you for your question. Very good. Any other questions by the audience? No. Thank you, Jorge.
Thank you so much. Bye-bye.
And the next presentation is going to be delivered by Alberto. He's the head of investor relations at ENCE. We applaud ENCE's participation in this conference to share and give more visibility to their expansion plans towards international investors. We also strongly like the ENCE's case at the moment. The company has 2 business segments, and as soon as they explained to us their expansion plans in their renewable division, we said straight away that we wanted to work with ENCE, and we saw that very clearly. So ENCE, in their renewable energy division, they've been able to generate, on average, 45 million euros of EBITDA for the last 10 years, and they expect to generate between 130 and 140 million euros of EBITDA by 2030. So that would allow the possibility, as they execute their projects, that would allow the possibility of a potential spin-off. When we've seen those cases, special situations in other companies, in some Portuguese companies, in some others, so value has always been recognized in the short term. This is not an investment case that we see just in 2 months or 3 months, but for the medium term, we're very confident that this is the right time to be looking at ENCE's information. So they have the renewable energy division. They have a 40% market share in Spain in the biomass market, and they expect to generate over 1 gigawatt in the bioethane market and over 2 terawatts in the thermal energy market. With just by looking at historical transactions in the market, if we apply the same multiple as we've seen in the latest transactions, and 10 times enterprise value EBIT, because let's remember that the biomass market, from our point of view, is a more attractive market than other renewable markets because of the characteristics. So if we apply the same multiple, we see an enterprise value of more than 1,100 million euros, which would lead to an equity value, as we've calculated expected debt also for that, so an equity value of 900 million. Let's remember that the current market cap is 725 million euros. So only the renewable business, with the expected plan that they have until 2030, as they execute, we believe it will be more than the whole company now. And then, well, there's Aliva, which is a potential event, as a spin-off potentially, and then also they have a pulp business. In terms of their pulp business, so the pulp business has generated on average 130 million euros of EBITDA. Over the last cycle, it's a cyclical business, and over the last cycle they showed that they were able to improve margins, and now they're very focused on improving margins. That's what they want to do, just generate business, improving margins, and we don't expect growth projects. We're just expecting like improving their margins, improving their business. Alberto will explain that properly. So 140 million euros expected in EBITDA on average the cycle, with an expected maintenance capex of around 40 million euros. You can, anyone can calculate what the expected value. We think that the company should be worth around 2 times more for the next 4 or 5 years than the current price reflects. And Alberto is going to explain that properly.
Well, good afternoon, ladies and gentlemen. Thank you very much for your attention, and thank you, Javier, for inviting us to this value conference. I know we are running a little bit late, and that is the last presentation. You must be a little bit tired. If I can ask for your attention, only 10 minutes, I will try to explain you our plans to create value for our shareholders during the next years, as Javier has already explained. There we go. Let's start summarizing or describing you our 2 businesses briefly. Please note, first of all, that we manage 2 independent and complementary businesses that are fully separated legally and financially. On the one hand, we are the largest, one of the largest producers of eucalyptus pulp in Europe. We own 2 pulp mills in the northwest of Spain that annually produce around 1 million tons. At the same time, we are the largest renewable energy generator using agricultural and forestry biomass in Spain. We operate 8 biomass power plants in the south of Spain. While the pulp business is a cyclical business, as Javier has explained, its operating margin largely depends on the international pulp price. The renewable business, the biomass business, is a regulated business, providing greater stability and visibility to earnings and to cash flows. Our main competitive advantages in the pulp business are 2. The first one is that our pulp mills are surrounded by eucalyptus plantations, providing local wood availability, which is cheaper than importing wood. And secondly, we have developed our own portfolio of adapted pulp products, which deliver higher margins than our standard pulp, and that already account for 1/4 of our pulp sales. On the other hand, our main competitive advantage in the biomass business is our dominance in the biomass market in Spain. We annually manage over 2 million tons of agricultural and forestry biomass. This is 10 times more than any other player in Spain, which provides a solid platform to diversify this business into other non-regulated but related activities, other uses of the biomass, such as the production of biomethane or the production of renewable heating. We aim to triple the recurrent EBITDA of the renewable business by 2030, while significantly improving the recurrent EBITDA of the pulp business. As you can see in this slide, and as Javier was mentioning, the average EBITDA of the biomass business during the last 10 years has been 45 million euros, while the average EBITDA of the pulp business during the last 10 years has been 130 million euros, totaling 175 million euros average cycle EBITDA. As you can see, the renewable business EBITDA is much more stable and growing, while the pulp business EBITDA has its ups and downs alongside with the pulp price, which is cyclical. Another important reference is the normalized free cash flow generation, which is the free cash flow before growth capex, and which amounts to 120 million euros on average during the last 10 years. Well, we plan to use this cash flow generation to grow and diversify our business while keeping a prudent leverage and an attractive shareholder remuneration. Let me start with our growth and diversification initiatives in the renewable business, aiming at, as I said, tripling the EBITDA by 2030. First of all, our subsidiary ENCE Biogas aims to produce 1 terawatt-hour of biomethane by 2030. This is 1,000 gigawatt-hour. Our unique business model is based on the valorization of agricultural and livestock biomass into biomethane with its corresponding sustainability certificate, as well as high-quality organic fertilizer. ENCE Biogas already has 28 projects under development with the land secured, with the feasibility study completed, and access to the gas grid. 14 of these projects are in the permitting phase, and we expect the first 6 of them to be ready to build already in 2025. We are also looking to accelerate this growth, looking into bolt-on acquisitions into already operating plants. We plan to build these projects using EPC contracts, project financing based on long-term PPAs. This is not a regulated business, but we will sign 10, 15-year PPAs. The accomplishment of these goals will allow us to generate 60 million euros of EBITDA by 2030. Another diversification initiative is using the biomass to generate thermal energy. Instead of electricity, thermal energy. Because the biomass is not only carbon neutral, but it's also more stable and price competitive compared to the thermal energy using fossil fuels. Our subsidiary, Magnum Servicios Energéticos, already signed a first operation agreement with a very important industrial company in the food and beverage sector in Spain last year. We are negotiating or working with another 14 industrial companies in Spain to provide them with thermal energy. And we are in advanced negotiations with 4 of these customers. We expect these first 4 projects to be ready to build next year. Our customers value our strong position in the biomass market, as I was saying before, and also our expertise in delivering full solutions from the sourcings of the biomass to the design and operation of the biomass boilers. As in the biomethane business, we plan to build these plants using EPC contracts, using project financing, and again, backed by long-term PPAs. Turning now to the pulp business, we have several projects to upgrade our pulp production into higher value, higher margin products. First of all, our ENCE Advanced Pulp, which already accounts for 22% of our pulp sales in the first 9 months of 2024, is delivering an additional margin of 30 euros per ton compared to our standard pulp. And this is because it's better adapted to substitute softwood pulp, which is made with conifers and which is more expensive. We aim to keep on increasing the share of these products to 30% next year and 50% by 2028. Already they are contributing with an additional average price of 7 euros per ton, which means 7 million euros EBITDA of additional EBITDA coming from these products already. So if we improve or increase their contribution up to 50% by 2028, we will be generating another 7 million euros of recurrent EBITDA in this business. Secondly, our project to diversify 10% of our pulp production into fluff pulp for absorbent products is on track. We aim to start this line by the end of next year. This is an innovative project that has generated a lot of interest among our customers in Europe, which are currently importing this fluff pulp based on softwood, which is more expensive, from North America. And they are really looking forward to having a local provider that produces fluff pulp with eucalyptus, which is much more competitive. We expect this product to contribute with an additional margin of 60 euros per ton when fully ramped up, which means an additional recurrent EBITDA of 6 million euros from this project. Thirdly, we have developed a portfolio of renewable packaging solutions which are able to substitute plastic food trays in the supermarket. This is a very attractive project with huge growth potential and very attractive returns. We plan to start with a first plant next year, able to produce 40 million units, which is not much, increasing our recurrent EBITDA by 2 million euros, with the possibility of scaling up in the future. At the same time, we have 2 projects to improve our efficiency, to reduce our costs in the pulp business. Firstly, we want to decarbonize our 2 pulp mills, starting with Navia, by substituting the fossil fuel that we use in the lime kilns with biomass. This is a project that will allow us to reduce our Scope 1 emissions in Navia, which are already very low, by 60%, and reduce its cash cost by 13 euros per ton. This means 8 million euros of additional recurrent EBITDA when it is developed by 2027. At the same time, we are finishing the engineering of an integral project to boost the efficiency and flexibility of the other mill in Pontevedra. This is a longer-term project. We are going to execute it during the next 5 years, aiming at improving its cash cost by 50 euros per ton, which means improving the recurrent EBITDA of this business by 20 million euros. Before concluding the presentation, I would like to highlight 3 important ideas. The first one is that the execution of all these projects that I have already explained is going to be adapted and aligned to the cash flow generation during the pulp cycle. That we want to keep a low leverage, and that we want to complement this growth with an attractive shareholder remuneration. So we want to keep our net debt to EBITDA below 2.5 times in the pulp business and below 4.5 times in the renewable business, while keeping an attractive shareholder remuneration. Just note that this year we have distributed 35 million euros to our shareholders, which implies a dividend yield of around 5%. 35 million euros is more or less the average of the last 10 years. Secondly, that we have a robust corporate governance and that we have a stable and supporting shareholder base. as well as an experienced management which is fully aligned with shareholder interests. And finally, that ENCE is at the forefront of the industry in sustainability. We have been ranked as the most sustainable company in the pulp and paper industry worldwide for 4 consecutive years by Sustainalytics. We have been awarded the EcoVadis Platinum Medal. We have been a member of the FTSE for Good Index since 2021, just to give you a few references. And that is all, to make it short and clear. And thank you very much for your attention. And ready to answer any questions that you may have.
Do you have any questions for Alberto? Yeah, there are some questions.
Yeah, thank you, Eric Isiger. Thank you for the presentation. On the biofertilizer, can you elaborate a little bit more on the biofertilizer and your experience in that field?
Yes, indeed. Basically, the business model in biomethane is using agricultural biomass and livestock biomass, turning it into methane and CO2 in an anaerobic digestion process. Then we capture the CO2, and what is rest is the same natural gas molecule, methane molecule, that we use everyone in our kitchens. Okay, and we sell that. We're going to sell that renewable gas through a BPA, 15 years BPA, at between 80 and 90 euros per megawatt hour. Okay, and that is going to allow other customers, industries in Europe to decarbonize simply by acquiring this renewable natural gas. The byproduct of this process is going to be an organic fertilizer with the same commercial feel and look as the chemical fertilizer that is already being used in Spain. Spain is already using 5 million tons of chemical fertilizer. This is going to be an organic fertilizer with the same chemical properties as the other one.
Yep.
And an additional line of revenues for the business.
Exactly, but have you ever had that experience or is that a new business venture?
It's a new business venture. And we are partnering with other companies in this industry.
Thank you.
Any more questions? Okay.
All right.
Thank you, Alberto.
Thank you very much.
Thank you all for having joined today. It's been a pleasure seeing all of you. You can expect a bit more of the same from Tenvalue going forward. It's not about us, it is about value creators, so we will continue being extremely selective. We will only work with companies that we consider value creators, and we will only show information on our website of companies that we believe that will be of interest for very good investors as the ones we are in touch with. Thank you very much for joining, and now it's time for the Tenvalue and drinks. Thank you.